Oh, okay, so there we are. Thanks to Philip Contra. Tarun Nagapan is here from Master of the Markets. We're going into, well, this is, I'll let Taru explain to you. We've got the next two presentations. I believe I'm not speaking out of turn, Taru, but I'm sort of going to complement each other because I know that you do some work with Gavin Holmes, who is also speaking um, at 2 o'clock. So let's bring through it first, and something happened there.
Can you hear me, Simon? Oh.
Hi, yes, I can hear you. Your video's off though. Um,
Let me see. Yes, I can see that. Video on. Does that work? Yes.
Fantastic, great.
How are
Uh,
you? Good to see you.
great.
Nice and sunny as always, Simon, in your
Uh,
place.
I've got the curtains closed, but white curtains they're not great for blocking out the light, sadly. But anyway, you're looking well. A bit of sunshine coming through the windows, and
Yes, that's right. Yeah, we can't complain here in the
everything
UK.
well.
We're
In
catching up with you. We're catching up with you.
Yeah, good news. Now we're going to do a presentation here this morning. You're going to be looking at price action. Your main tips for trading price action. Gavin's coming later, but I know you guys have been working on something together. An indicator, is that?
That's right. And I think Gavin will be. Yeah, he's here as well.
Oh,
Gavin
here.
is here.
Hi,
He's
Gavin.
listening in. Um,
Oh, wow.
I think it'd be good if you can allow him to speak as well, Simon, because it's really good what we have done. We have combined price and volume. I'm going to be talking about that. I just took a cable trade before I came in,
Yeah.
got out of that. Looking at the DAX for now. Yeah, so it's going to be really good for the attendees. Yeah, we're really looking forward to it.
Well, Kevin, if you want to come in anytime, just let me know. I can invite you onto the screen. Otherwise, I know we've got a special slot for you coming up afterwards. So, Drew, let me hand over to you. Obviously, you've been in the markets a while. I know you've spoken at these events before. A lot of people will know you from Master of the Markets. Um, you've been trading a long time, but you actually trained initially in pharmaceuticals, biotech, and
That's right, cardiovascular pharmacology. Yeah, I used to do my research in that, Simon, and then from there, turn of events, then I got into financial trading.
you never looked back.
That's right. Yeah, we've always applied those research skills on the trading, and that's a key thing in our company. It's very
Yeah.
different.
Shall we share screens just to make sure that that works okay for you?
Yeah,
If
no
we,
problems. Let me just do that quickly, and I think I've got two windows, so I think it should work. Let me see. Should be at the top, isn't it? Share screen. Let me see. Entire screen is better. Screen two. Share. And can they see this over here?
that's great. Yeah, we can see the slide now. If you put it into
Yeah. Um, and also, I think there's a way to look at the. Oh yeah, let me bring it to the other thing so I can see what the.
put it onto the other screen. Yeah.
Yeah, that's right. What the audience are all
So we're now.
saying. I guess.
Yeah.
I think that's fine. Yeah, I think that should be
Fantastic. Okay.
good,
Well,
isn't it?
I'll let you get started. You want to tell people a little bit more about what you do over at Master of the Markets and how it all works? I know you're sort of building up quite a big community there now.
Yeah, that's right. So I think yeah, we'll go straight in. I think before that, I think very quickly, just let me see any opportunities I'm looking at. I'll just give you guys a brief overview. We just took a cable position. I'm going to be explaining much further. Also using the volume indicators that Gavin and team at Trade Guider have done as well. So cable here, we took it on the stats over here on the blue line over here. I think if I were to show you guys, we just took a small scalp over here onto the green line over here. You can see on my profit balance just a very quick 80 quid profit that we took around there. I'm taking a look at the other one, which is DAX at the moment. I'm looking at the daily over here towards a turning point of upside, looking at the stretch principle, which I've talked in previous RTCT webinars as well. towards the upside, what we're looking for, and a confirmation of this bottom. So these are roughly the things I'm looking at. I'll look at more later on. But for now, let's go on to the presentation and I'll come back to the charts again. Okay, cool. So just a little bit about us, just disclaimers over there, just that this is for truly educational purposes. That's a face to me over there. Just a little bit about us. We've hung around some really great traders like John Bollinger, founder of Bollinger Bands, millions of trader screens. You guys would have definitely known about him. Jim Rogers, co-founder of Quantum Fund, net worth 300 million. As well, Elite Traders Conference, we invited a US trader, quant trader from US. We are very well known for our quantified approach. Elite Traders Conference, we invited him. Actually, interesting thing is that Mark's mentor started with nothing, but he became a billionaire trader after that. Break the Time Money Link, we are the good founders of that. Traders Open Day, where we invited different traders as well, some of them which you would see in RTCT2. We have 38 years of cumulative experience between all of us over here at Master the Markets team, 20,000 people over mentored, and we run live trading workshops and seminars where we catch the trades live. You can find out more about us at masterthemarkets.net. Okay, so that's that. Our mission is really to spread the truth of trading, not to give you the hype that every single trade is going to be a winner or you're going to be a millionaire overnight. That's nothing of that. In fact, I really like how Simon does all this RTCT events where he chooses really good quality speakers and they all speak the reality of trading. So that's really good. So we're all in this together actually to spread the truth of trading. We've been going on since 2010, so it's been quite a long time, and I've known Simon for easily about 8-10 years as well. So really good, all towards helping you live a better lifestyle. Today I'm going to give you 3 price action tips, and trust me, I mean, most people who listen to our presentations will usually come to us later on saying that, Tiru, most of the stuff that you share with us, we never usually see it anywhere else out there. And that's what you're going to be seeing. We're going to show you 3 price action tips. And this is all going to be backed by stats as well, all based on probabilities, which is what trading is all about. You're going to see how we apply them in real market conditions and also live trade examples as well. Okay, I've shown you already some, but we'll go and take a look at them much more in detail as well in real life conditions. And I'll also overlay the volume indicator on top as well, which Gavin later on is going to be delving further into it and see how both our methodologies actually come together. Right, so 3 price action tips. The first price action tip, what I want to give you, traders, is you must always know upon point of entry. The problem is, what I've always found with most traders is when they enter a trade, wherever it may be on the chart, they do not know statistically how much move is left. How much move is left? Wouldn't it be good for you to know wherever did you enter on the chart? Wherever did you enter on the chart? For example, where we scalp this trade on cable over here, wouldn't it be good for you to know from this blue line here how much move is left and place your targets accordingly? Look at what happened here, right? So we had a big red bar come in, but I placed my target tactically and I got in before it started to reverse against me. But of course, at this point, some of you might say, oh, it might come down later on, I have to just wait. But what if you knew the statistical number? Wouldn't that be good to know? Type into the chat box if that would be good to know. How much move is left on a statistical probability manner? Wouldn't that be good to know every time you enter a trade? Based on that question of how much move is left upon point of entry. Yes, yes, I can see, most of you are saying yes, that will be a good statistical number to know. So how do you actually go about finding that number? And that's what we have done over here, traders. How much move is left is what is known, and this was taught to us back in the 1960s. This work actually started in the 1960s by my mentor's mentor, and that's how we learned this. It's called open equity. Every time you enter a trade, you must know how much open profit there is. Okay, how much open profit there is. So for example, you should know what is your 80% open equity distance, your 50% open equity distance, and 20% open equity distance. Now, how do we find all that out? Okay, this will help you with target setting so that we can get out at those numbers so that the trade doesn't go against us and we go back into realized losses. Now, let's take a look at that. Let me go on to trading view. We've programmed this entire thing onto trading view, which I also spoke in the last around the clock live as well. So let me just see what I can do here. Let me just stop sharing just for a little bit and let me bring up this chart over here on cable, right? And let me just start sharing once more. This will be entire screen. There we go. And I guess you guys should be able to see this, right? My cable chart and the 1 hour time frame on trading view. If you all can see that, yeah, just type in yes. Okay, that's great. I can see that. Thanks for that, Simon. So over here, traders, as you can see, what we got over here, you can see that there are some arrows and there are some dots over here. Can you all see that? Arrows and dots, yeah? The tops and bottoms that we have programmed into the trading view system on the 1 hour. Now we also got this stats chart over here as well. All that tells you is every time the dot comes in, which is basically all this indicator what we have programmed here on the trading view, which is proprietary to master the markets, all we have done is every time this dot and arrow comes in, all we are saying is that this bottom has been confirmed according to our formulas. And at that point, from the start, the starting point, where does it begin exactly in that bar, is basically at the close of the confirmation bar. Okay, the close of the confirmation bar. Let me put that as a blue line, right? So that's my blue line over there. So that's my blue line over there. So that's the starting point at the close of the confirmation bar. Now, from the close of the confirmation bar, right, how much move is left? And that's what this stats chart tells me. It tells me that from this blue line onwards, it will get to 10 pips 76.79% of the time. Okay, now this is very powerful, isn't it? Every time when you get that bottom or top quantification according to our formulas, you know on a probability basis, which is a good projection power, to know how much it would travel 76% of the time or 60% of the time or even 50, 20, 30 and 20. So that this gives you a realistic approach to the entire thing. And from there, you can then construct your strategies and your target setting accordingly. Okay, so that's one good thing. So now in real time, so if you remember, I took a trade over here, right? So as you saw on the chart over here, you can see the blue line which I took over here after the confirmation dot came at the reversal of this green bar over here. I took that to this green line here. Now you may ask, why did I take it only to that green line? The reason is all in this chart over here, all in this stats chart over here, right? So you can see that from the dot, which is the close of the confirmation bar, my race, if you may call it, the race begins. From that point, traders, I take it, looking at the stats chart, I took it to 15 pips from there. Okay, 15 pips from the close, just in between, so that I get about 65, 70% target. And that's where the green line came out to be. So if you take a look, so the broker will vary a little bit. But over here, close price 12288 minus 15 pips. That's about 12273, is it not? So 12273. Let me just bring that line up so that you guys can get that and understand that what I'm saying here. And that's how I did that. Okay, 122 7.3. Let me put the settings one so I can get a bit exact. It is about that 12273, and that's how we got that target line, which is what you're seeing over here, and which is how we banked in the profit, which I showed it to you before, which before it started to is reversing back now. And then at this point, most traders will be thinking, oh man, let's wait, is it going to come back? And then of course the worst thing is if it keeps going up and up and up and up, then you're back in unrealized losses, and if you exit it, then it becomes a realized loss. Okay, so that's how we are doing this over here. So this is all programmed, it's all on the probability stats, and we can also apply this on any time frame. We can apply this on daily time frame too, and it will tell you exactly based on when the confirmation comes, how much move is left. Okay, the whole thing has been designed actually very in a very smart way, and all this work started in the 1960s by my mentor's mentor. My mentor actually has a hedge fund and he trades for Morgan Stanley's money. And he learned this back in the 1960s, which we were very lucky to come across these guys. And I must say, until now, and as we were, started off the webinar, with my cardiovascular pharmacology background and research, I don't actually usually accept many things just on face value until I test it. And this thing just blows my mind until today. And this is one of the main reasons why also we have partnered together with Trade Guider as well, which Gavin will be talking about later on, how we're combining both these methodologies. Now, so that is to do on um, the open equity, how much move is left on what these guys have done. And the whole basis of these traders, before I move on to the second price action tip, is all based on swings, is it not? Most of us here, if you're listening to this, most of you traders are somewhat kind of swing traders. Even if you're scalping on one time frame, you're somewhat capturing some part of a swing in another time frame, is it not? Type in yes if that's true, right? Most of you are swing traders. You're capturing some part of a swing on another time frame. Now, what these guys have done, these quant traders, is they've quantified the swings, because what defines a swing is a bottom and a top, is it not, traders? Then the thing in between is what we all want to capture, right? All these guys have done is put a framework and quantified it, starting the work in the 1960s. Okay, and the main thing for that was finding the open equity, which is basically how much move is left on a probability basis upon point of entry. From there, you can then do your stats accordingly. Okay, so that's what this is about, and that's what you saw over here, open equity on the trading view. And this is what you can do, different strategies based on all this, and you can get your target setting. I usually will set a larger target if the time frames align. So for example, in terms of cable, why didn't I set a larger target, a 20% open equity? Because on the daily time frame, this is an uptrend, a bottom to top move towards the upside. Even if this is a turning point, my range of the bar as well, there's not much range to capture today between the high and the low. There's only about 5 pips left, and that's why I'm not actually, I didn't set my target that high on the cable. Okay, so that's the main reason. Now, just a quick glimpse, I also just remembered as well. What I want to also show, how we are now using, in terms of using the volume as well, we got the VSA light over here, and you can see that anytime we get a dot and we have a gray dot, just like here on the VSA, or we get a red dot. Let me just do a red dot over here, which Gavin will be explaining much more later on in terms of the VSA light. We usually will take a position in as well. And according to this stats, it gives your probabilities much more. Okay, so three things we are aligning. One is the SMI dot, the two is the VSA dot, and then finally we are then using volume analysis with price action analysis to finally take the trade, and then looking at the stats to set our targets and so on and so forth. Okay, so that's the first thing I want you all to take away. How much move is left, and that's how we made this money in real time. Okay, I'll take a look at more charts later on as well. Let me just quickly look at the DAX as well. I was just taking a look at it just now. Now, this is another one that is setting up now. If this bottom here confirms, I will be starting to take a look at taking that trade on forward based on the stats chart and based on alignment. And this aligns as well along with the daily, because I'm looking for the daily to confirm this turning point towards an upward side. Okay, so I'll talk about that later on a bit. Right, so that's the first one. How much does it move open equity wise? Okay, so that's that. We went through the practical. Now, the second price tip. Now, not only is it important to know how much move is left upon point of entry. So, for example, let me tell you this. So, we got this bar here. So, we got the point of entry here. Now, from this point of entry, not only is it important to know where would the target be in terms of a probability basis, but also traders, you would agree with me that it's also important to know how it will get there. So, for example, one way it can get there is just a straight line, and that's everybody's dream, right? As traders, isn't it? Just straight line, green bars up, and it just hits the target. But, every time that's not the case usually, isn't it? It can do this right from the beginning, it can go against you, and then after a while, then it moves in your favor towards your target. I'm sure all of you have experienced this, isn't it? Sometimes even it's even in this way, which is, it goes in your favor a bit, and then after that, then it comes back down against you, and then before it then moves up further towards your target. Am I right to say this? Type in yes. I mean, if you guys have experienced it or any other challenges that you may have had. And also, we have programmed this as well, so that you can get the numbers effectively on a probability basis, so that you can know where to position your stop losses so that you do not get stopped out. Would that be a good figure to know, traders? Tell me. Punch into the chat box if you think that would be a very good number to know. Where to place your stop losses on a probability basis so that you do not get stopped out based on this question on how does it move to get there. Yeah? Yes, as most of you agree, yes, it would be good to know that. Now let's take a look at that. This is what we call maximum adverse excursion. Maximum adverse excursion. So from the point you enter, how much does it move below the blue line before it goes up? Okay, how much does it move below the blue line before it goes up? This is what we call maximum adverse excursion. And you see, the quant traders were very smart, wasn't it, traders? Because when they did it in 1960s, they knew that to find all these numbers, the first thing they need to lock in is to quantify what a bottom or a top is according to formulas. And once you got that, you can derive all the statistics, which is so useful for traders. And that is why, Gavin and us, Trade Guided and Master Markets, have partnered together, because, understanding this price action philosophy with stats backed and with volume backed as well, volume analysis as well, it becomes too powerful, right? It becomes too powerful, right? So that is what I'm saying over here. Maximum adverse excursion is against point of entry, which will help you towards your initial stop loss and also your profit taking MAE, which is towards your trailing stop loss as well. Okay, profit taking in terms of your trailing stop loss if it hits your trailing stop loss. This will help you increase trades hitting target. Now let's do a practical on this. Right, let's go on to trading view again, and I'll show you how we have programmed this, and you can see this in terms of stats as well. Okay, right, let's take a look at this. Now over here at the moment you're seeing all this. This is open equity in a 1 hour chart. Now let me move that and change that to a maximum adverse excursion numbers. Yeah, let's do the settings over here. Let me change it to MAE, and I got to change my sign here, not to greater than equal to, but to less than or equal to. Okay, so I'll do that now, and I will do that, and I'll keep it 10 and 10. I'm just doing on GPUSD. You can do this on any other instrument. Once I've taught you all these three stats, we will take a look at all the other instruments. Okay. Right. So over here, what I can see over here in the stats chart, what is it telling me? Right. It's telling me that 61% of them, so it's measuring 797 bottoms and tops, or in other words, 797 dots over a period of 13 years, right? So of course, you guys can appreciate that it would take us too long to do it manually. You see over here, 13 years, you can do it. Just put 2030, but it's measuring it until 2023 this year. So 13 years is measuring over that period, is measuring all that dots, right? All the bottoms and tops. 797 in total on a 1 hour time frame. Out of the 797, 488 of them, okay, or in other words, 488 divided by 797, that is about 61.23%. 61% of them traders will move against you 10 pips before getting to the top or the bottom. So for example, if I were to show you here, all it's telling me is if I were to take this line here, so let me just delete that line. Yeah, so let me look at that. So the close of the bar here in real time is this one here, the blue line, right? So how much does it move against me before going to the bottom? Okay, this might not be the bottom yet because it hasn't confirmed. So let me do it on something which has already happened. So maybe let me see if I can do a replay mode here. Let me do that. Oh yeah, that's the intraday chart, isn't it? So let me do it over here. So let me do it over here on this one here, the close over here. So then here, let me just do it on, let me change that to red so that you guys can understand what's actually happening. So you see, let me show you guys what's happening here. So from here, let me just hide the VSA for a little bit. So you can see from the starting point to the maximum point is here, isn't it? Yeah, that's the top. So in between this, from my point of entry to the maximum point reached, which helps you in terms of target setting, how much did it move against me before going to the top, right? So how much did it move against me before going to the top? So it went all the way here before going to the top. So in terms of that, you can see that in this example, it went against me this amount of number, isn't it? Up to 12258. So in other words, from the blue line all the way to here, so let me just do it here, I can show you. It has moved against me about 45, 44 pips. To be exact, that's what this thing number is telling you. It moved against me 41 pips over here, you can see, right? So like that, it's gathering all of this, 10 here, 10 there, 28 there, everything is gathering onto this stats chart. And it's telling you that 60% of them move against you 10 pips, 80% of them move against me 20 pips before making a bottom or a top. So this will help me traders, and 96% of them move against me 40 pips before getting to the bottom or top. So how does this help me? This helps me with putting my initial stop loss effectively so that I do not get stopped out. So for example, according to this stats chart, if I place my initial stop loss 30 pips away from this blue line, then I would not get stopped out 92% of the time. Isn't that powerful to know on a probability stats basis? So how do I apply all this in real time? Look over here. So in real time here, you see, if I put my entry here, which I did, and let's say my target as I placed it, if I were to give it enough room space, I would know that if I do not want to get stopped out, 90% of the time I need to place it 30 pips away from there. So the close price here was 12288. So therefore 12288 plus 30, that would be 12318, isn't it, traders? 12318 is what we are saying. So I would just place it there, and that's one. I won't get stopped out before it gets to my bottom. Okay. In this example here, yes, it did go against us much more, but of course our entry was only after the green bar, so that's why we didn't get stopped out in this trade. But this gives you a really, really good idea of where to place your stop losses effectively so that you do not get stopped out before it gets to your target or your top or your bottom. Does this make sense to everyone? And we can do this across any chart. We can do this across DAX, Dow Jones, gold, anything you name it, we can do it, whatever the trading view offers. Is this clear then on MAE, price action tip number 2? So we've gone through open equity and we've gone through MAE for now, right? How much move is left and how does it move? How much does it move against you? Is this clear? Any questions? If any questions, just type it in. I'll handle them all later on as well. Okay. Just want to quickly put the VSA on here as well. I want to see how that's looking like. It's still gray dots at the moment. So it's not turned into the green. I just want to take a look at the DAX very quickly as you guys are looking at as well. And that's signaling towards red at the moment. Okay. So not really giving us the full on go ahead signal towards long. Okay, cool. So that's that one. MAE practical. Okay. If there are no other questions, I've got a question for you guys, and we will be giving away this prize over to you guys as well, which is the Money Master the Game book. So let's see who's been attentive, who's been listening in properly. So Money Master the Game. This is where Tony Robbins actually went to interview the top millionaire and billionaire traders around the world. Okay, so those of you who haven't read it, it's an incredible book to have in your hands and to understand the different ways and actually how we can master this whole game of money. Okay, and where he also interviews a lot of top traders out there as well and investors. So let me ask you the two questions, and those of you who win it, you will get e-copy of this book as well, or a hard copy, whichever you choose. You just need to send us your details. So let me go for it. So the to win this prize, here are the two questions. So the first one's to answer it first. The two questions are this. Let's see. What is the definition of open equity? And how can MAE be used in a strategy? So go ahead. Let's see who gets it first right. Let's see who gets the answers right. Those of you, I know you'll take some time to type it in. I think we'll give you all some time. And as you're typing it in, maybe I can also move forward. Let me actually check the. Yes, getting some answers. Let's see. There's two questions. Let's see who's the one who gets both of them right. As you're typing that in, let me just quickly go on to the charts and see how they are doing. The DAX, we are actually getting this momentum at the moment. The bottom has not been confirmed. Let me take a look at the Dow Jones. Now, Dow is proving to be a potential opportunity. Let me just bring that onto here. Dow Jones here. There we go. And let me just put our indicators onto there so that you guys can see it. As you're all typing in the answers. There we go. Right. So we got a bottom to top move on the Dow, and we are having a good alignment here as well in terms of confirmation as to. So I'm just going to see, yeah, so that will close at the end of the hour. Let me take a look at 30 minutes as well, see if that's going to confirm. This might confirm. I might take a live position on this. So that will be basically on the close of that bar there. Right. Let me just put a blue one there. Okay, so that's happened at 1:30. So that will close at 2 o'clock. So wherever it closes, and our stop loss will be for the low over there because we've got to give it a bit more room. Right, so that's that one there. So I'll come back to the Dow Jones. I'll put it onto the trading view as well. So some of you have given it. Connor, I think you have got that right. Yes, how much price could swing against you? Definitely. You got both the questions right. That's brilliant. Please do send us your details of name and number and email address, and boys, the team at Master Markets Client Service will get in touch with you. Okay, just your name, email address, and number. Good. For those of you guys who are wondering, Tiru, this is a bit of information. I'm not sure of some of the terminologies you're using and everything. Really great place to go and take a look at traderstarterpack.com. Okay, traderstarterpack.com. I will put the link into there, and then you guys can register for it and look into it as well at your own free time. So let me do that. There we go. That's the link. You can look into that. I think Simon might have also put it there as well that you guys can take a look at. It's a 5-day video series, and you can learn it at your own pace, but it will teach you all these concepts which you'll never see anywhere online, which is on open equity. How much move is left? The exact definition of open equity is point of entry to maximum point reached. And that's how we get the statistical charts. Okay, good. Now, I've given you 2 price action tips. Let's now move on into the third one. Okay, the third tip. We've looked at how much move is left for target setting. Thanks for that, Gavin. That's a nice flag up. I will take a look at Aussie very quickly as well. The first thing is the target. We looked at open equity. We also looked at how much it moves against you as well, which is MAE. The last thing you would appreciate in any race, once the distance is set constant, and if you want to find who's the fastest runner, what do you then do? You look for time, right? How long does it take to get there? Now, how do you think that will help you in terms of your strategy? How do you think knowing how long or the time taken to get to the target will help you in terms of your strategy and trading it with conviction? How do you think that will help you, traders? Type that into the chat box. And as you're doing that, I'm going to take a look at Aussie as well, which is setting up, which is what Gavin just gave me a flag up. Let me take a look at Aussie over here. I have, let me see, let me put Aussie into here, and I'll do that onto the daily on trading view as well very shortly. So let me just do that and just do this. As you guys are having a think on why will time 2 help you in terms of your strategy? Why will that statistics be helpful to you? That's what I want you guys to have a think on, yeah? Right, so I will take a look at that in a minute, Gavin. Let me just set all this up. That one here. Smart money elites. True. And there we go. We got our arrows popping up here. Yeah, so Gavin is flagging that up over there. Let me just do a quick analysis here. I'll just do the Aussie here as well. I'll put that onto TradingView too as well. I will do this. I'll set this up here too. So let me know, guys, into the chat box. Why do you think time taken to target will be very helpful? And how will it be helpful to you in terms of your strategy? So over here, what we are looking is, I'm looking at this bottom confirming towards the bottom to top, looking towards this going further higher up today is what we are looking at. But however, on the 1 hour, as you can see, and it's what probably Gavin will be looking at as well, you can see that it did do towards upside. Now it's towards its downside here, and it's taken out this last swing low. If this maintains itself, we might be actually looking, if this bar here maintains itself towards the upside, I might look for a reversal towards the downside and forming its range towards the downside. I'm just going to take a look at the trading view chart as well very quickly. Let me quickly just bring that up on Aussie dollar. Then I'll go on to the last price action tip on time taken. Okay, so let me just bring that up over here on Aussie dollar. Let me just put that up, launch the chart, and let me just quickly get that back up there, and which will load on the 1 hour time frame. So there you go. So what do we have at the moment with the SMI Elite and the VSA indicator all overlaid on top? Firstly, in terms of the SMI, what we do have is we have a bottom that has been confirmed so far. And in terms of the short position, it's a gray if you want to take. So if it's a gray, it's still fine. We can look into that. But as of now, it's still signaling towards upside over here when I align both the indicators. Okay, so we'll look for some cues and we will take it on from there. So we'll take a look at that later. And Gavin will be analyzing that much more further as well in the 5 minutes as well. Right. Okay. So let's take a look at price action tip number 3. How long does it get to get there? And some of you were saying that in terms of time taken, this will help us in terms of trailing our stop loss effectively, whether we want to make it tight or still conservative or give it some room. Let me show you what we have done over here and master the markets. Time taken towards top or bottom towards X target. So this will help you reduce your average loss. So what do I mean? So let's go on to the practical over here. So let's see on the charts over here. So if I go on to GBP USD over here, so in terms of time taken, let me show you the stats, right? So I can do either time to a top or a bottom, or I can do time to a certain target. Let's say if I did time to a certain target, let's say I just did to what we did on the 1 hour time frame, which was 20 pips, right? So let's say 20, I use less than or equal to, and now each bar will be 1 hour. So I start my table at 1 and 1 and increase it by 1. So now we'll start to populate over here over the last 12 to 13 years. It tells me that for a target of 20 pips, right, which is what we did, it will get there within 1 hour, basically within one bar, 38% of the time, right? What I'm really concerned about is that 80% of the time, it's telling me that it will get there within 5 bars to 20 pips, right? So if I want most of my trades getting to a target of 20 pips from the dot, I need to wait for all 80% of them to get there, which is 5 bars, which is 5 hours, right? But of course, remember traders that this is taking all in consideration of all those trades that got to 20 pips. All right. So you see, after 4 hours, what we can do, actually, we can start to get tighter on our stop losses if it doesn't get there. And the same thing that's happening here as well, isn't it, at the moment, right? So after the dot, if it doesn't get to my 20 pip target, right? So if you want to project for a 20 pip target, which is still over here, let's see over here, 2283, 12263, still it hasn't hit the 20 pip target, right? So let me put that for you in terms of um, diagrammatic format for you. So 12263, and then once I've done this, once you guys got the idea of this, so you see to get to this target of 20 pips, right, from the blue line to here, right? How long will it take? 80% of the time it will take 5 hours. So at the moment, what do we got? 1, 2, 3. We got 3 hours. So there's still chance this could be one of them, which will get to my target within the next 2 hours. So if you actually want to play with this, and if you still want to take a position, you can go for the opposite side of this green bar at the moment. So you can put a position for the low of that green bar and a stop loss for the high and aim for this target, right? And if it gets there still within 5 hours, is it not, traders? Yeah, there's so many ways you can use this stats. It's just very flexible. It's not rigid. Okay, cool. So that's the time, right? So once you lock in the target, You can see how long it takes to get there so that you can trail your stop losses effectively and place your initial stop losses effectively using MAE as well. Does that make sense, traders? Do let me know if it does. Now, remember that none of these stats, the three stats that we looked at, the three price action tips that we looked at, you can never do that first without quantifying the tops and bottoms, which is what the quant traders did back in the 1960s. Okay, started the work from there. And most of this is covered in detail in Trader Starter Pack. Okay, so you can go ahead and look at that. We've given you the links and you can watch through the video courses for that. So that's how it all began. You have to quantify the tops and bottoms to get to these three stats. Then you combine that into your strategy. Okay, but the first step is always quantifying your tops and bottoms. And how do we know which quantification is better? Because some traders might say, Tiru, why is it that Master of the Market's way of quantifying is better? The only way you would know whether it's better or not is by comparing one quantification to another and see which produces the largest open equity. You compare the stats table. And this is explained further in the Trader Starter Pack video series. Okay, right, cool. Now for the second interactive exercise, let's see who's been listening in for you guys to win this prize. Also, another thing I must say, yes, as I said, the time, right? I talked about the time stats, we talked about the MAE, and we talked about OE as well. Okay, two types of time stats you can have: time towards target or times towards a top and bottom. Okay, cool. Right, so now for the interactive exercise 2, let's see who's the second prize winner. Connor won the first one. Now the second one, let's see who wins it. These are the two questions. What are the two types of time stats we can use in a strategy? And what is the first step to deriving the three stats with validity? What is the first step to deriving the three stats to validity? So go ahead, punch into the chat box. I think as you're doing that, then we can take a look at some charts over here. Let me take a look. Cable has reversed back, I can see. Let's take a look at euro dollar. Euro dollar is a good one actually. I'm looking at. I think this will correlate well on the VSA chart too. Let me take a look at euro dollar here. Yeah, SV, I think you're saying something here. Let me take a look. What was this first step? Yes, you're absolutely right, SV. And the other one, this question here, let's see if we can get the other one right too. Then we can take a look. As you're looking at that, let me take a look at euro dollar. This was another question, wasn't it, guys? So the other question is, to win the prize, what are the two types of time stats we can use in a strategy? Okay. As you are doing that, let me take a look at the DAX is moving up further. Let's see, Dow Jones, Aussie dollar. Let me take a look at euro dollar as well. Euro dollar. And I want to put this on the 1 hour chart, and I want to overlay the VSA as well. I mean, Gavin can take a look at that later too. Let me take a look at that. And the VSA, let me put that. Yeah, so there you go. So what I'm looking for here, traders, on the euro dollar, I'm getting a green signal here. It's a gray dot at the moment. If I do get a bottom confirmation here on the SMR, so if the bottom comes and this confirms that bottom, so if I get a dot on this green and here, that's the exact point for me to take a position towards the upside. Because if you take a look, if you take a look on the daily time frame, if you take a look at the daily time frame, that's also aligning with my daily time frame with a bottom to top move over here. If you guys can see that, right? So at the moment it's an uptrend and also it's a bottom to top move. So that's a perfect one for me. It's all aligning together with the volume as well. VSA light indicator too. So that's all in alignment here, as you can see, right? So as you can see all of that. So I'll be waiting for that bottom to confirm on the SMI, and then we can be looking for a long position here on the close, stop loss for here, and then the target according to the range or to my stats chart that we will have. Okay, good. I'm just aware of time. And then before we pass it on to Gavin as well, it'd be good. Oh, I think I'm very close to just closing up. I'm just putting that for you guys. Entry here wherever it closes if it confirms, and stop loss for the low if it only confirms. Okay, so we have to be disciplined in that. Now, what do we have? Number of bounce to the next and what probability that it hits? Yeah, I'll come to that question. I think for now, I think it's a double, isn't it? I think SV has done it. SV, I think we'll just give it to you because you got one of the two ones right. So if you can give us your name, contact number, and email address, then our guys will contact you to give you the price. I think these are some live trading examples we've taken from the past. Euro dollar, 22 pips, all on the same methodology. It's on one day exit. A lot of our clients take it. We did take Euro dollar and GBP USD yesterday as well. And we did hit the targets on 80% open equity based on the stats of how much move is left. So that we did over here on the this is on the 80% OE, this on the 50% open equity is another strategy which have taken 60 points on the silver, and at 10 pounds a point, that's 600 pounds. In terms of dollar Swiss, that was a loss, 61 pips, 610. We lost on that in 50% open equity basis. This is a euro yen chart, 3010. That was a nice move swing that we took over here on 301 pips over here that we took in real time. On the 31st of October here, euro dollar, we lost a little bit on 83 pips over here. Again, on the confirmation dot, based on knowing the open equity distances. And the last one being 50% open equity. On Brent oil, we took a nice swooping profit of 523 points. We even took one recently as well on Brent oil on in terms of open equity as well, 5,230 points here as well. Okay, so good. Trader Starter Pack is where you can um, find out more about this as well. So we will let me just put that back onto for you guys here. Yes, thanks for that, Simon, for doing that. Yes, winners, you can email us over here. We already sent a message. Yeah, we've already sent that. So you can find it on the chat box above on this link in terms of Trader Starter Pack, which will explain to you all these different ways. I've completed the presentation. Now that you should know the 3 price action tips to give you a winning edge. The 3 stats, as most of you know, how to apply them in real market conditions to achieve consistent returns, and live trade examples to help you trade with conviction. To show you that the methodology really works, traders, I come to the end. So I'll look at more live charts now and take questions. But to show you that the methodology works, look in real time, right? Look at this, right? On 1 hour, we took the trade on the low, took out a 15 pip target, and look now, it's gone all the way against us. That is the power when you know your open equity number. Yeah, that's the power when you know your open equity number. And that's how you see over here, we took a small profit and we got out rather than losing much more on it. Isn't it not, traders? Yeah. So that's what I want you all to get away from all of this. Once you know your open equity numbers, you can trade with much more confidence. Much more confidence. I'm keeping an eye on euro dollar. Still not confirming our bottom, so we won't be looking at that. Aussie dollar, which is what Gavin gave me a heads up on. Be keeping an eye on that as well. Let me just take a look. Aussie dollar at the moment, bottom to top. If it does confirm its bottom, we'll be taking a look at that. But of course, you can take that And the lower time frame is what Gavin is looking at as well. We don't even need to wait for 1 hour confirmation. If you want to take a small scalp based on these open equity numbers, we can always take a look on a smaller time frame too, which is what Gavin is looking at. He's capturing a small part of this swing before even this even confirms on the 1 hour. You don't need to ride it. There's so many different ways you can look at it, and so many different ways you can play with it as well. Okay, in terms of open equity, MAE, and time taken. For those of you who got any pressing questions still, you can always do a one-to-one session if you want to ask us more about the smart money indicator or the VSA as well. The volume analysis, I've put that over here, one-to-one session. You can look at my calendar, you can book it in. We're giving the first one for free, so we're happy to help traders. So you can definitely look into that. And the last thing what I do want to say, traders, is that I know a couple of you booked in straight away after the last session that I did, because you said we have not seen anything like this and nobody talks in terms of probabilities. The last thing I did want to show you guys was that, let me show you this. On trading view, there we go. If I put another tab, is, yeah, I think I've got that open actually. So we've got the trader starter pack, which you can register for a video series. And the other one was we've done a landing page together, trade guider and master the markets. So we got the price action, smart money indicator, and the VSA together. So you can go onto this page. We will send you more details when you come to later on the one-to-one sessions or in our database. You can see all the videos and everything all in action, and you will get both of all of that overlaying to each other. And you also get an intraday room with me and Gavin as well to support you guys on this journey forward. Okay, so I guess that's pretty much that from me. Simon, I think I've got some questions here. Shall I answer them? And then Gavin, maybe you can come in as well, and so that it would nicely swift into you too.
Yeah, that would be great. Drew, let's maybe wrap up the questions. What we'll do is we'll close this session
Uh-huh.
and reopen the next session with Gavin, because when people go back to watch the replay, it's part of an agenda. So um,
Yeah, I
you
think there's one question only here, I think, isn't it, Simon? How many bars to the next top or bottom, and what probability that it hits that top or bottom? The answer to that question, SV, is in the open equity tables, is what you will find. So when I change this to open equity number, then you will get that question answered basically. Of course, if you want to ask me any more in-depth questions, look at my calendar, book a one-to-one, and also look through the trader starter pack. This will answer most of it. So this is answer to your question. So it will tell you 77% of the time we'll get to the 10 pips, and then 60% of the time we'll get to the 20 pips. Then it's a matter of selection of the dots. I think that's that, Simon. I think
okay, fantastic, Drew. Thank you so much. I'm going to just basically close this up. We're going to open up the next session under Gavin's title, but stay in the room with us if you can. I don't know, maybe Gavin will want to refer to you as well. So if you can hang on, that would be great. But
yeah,
for now,
definitely. I'll come in, sir. Yeah.
we'll close this one. To
All right.
the markets. Thank you very much.
Thank you, Simon. All the best, guys.
whilst I'm running on this side, Wyckoff Williams, I promised Tom Williams, the late Tom Williams, who is here, that I would always teach others the knowledge that he imparted to me. And it's very important to me. And that's why I do these events. And I thank Simon Campbell and the whole team there, because by doing this, you get lots of different views. It doesn't mean one is right, one is wrong, or anything. I learned from Tom, and then I also went and met lots of other traders. I've indeed worked with some of the greatest traders, I believe, in the world, David Weiss and the late Hank Pruden, all Wyckoff experts. But what I learned, and what's important to me, is there's always opinion in the market. Okay. And this is what I'm going to show you today. And I'm going to show you how the footprint of the opinion of what Wyckoff called, and we'll talk about Wyckoff shortly. And Wyckoff was a trader from the 1920s and 30s who talked about the ticker tape. Now, what's a ticker tape? You probably won't even have heard of it. It's how they used to trade. It's how JP Morgan took down the market in 1928 before the Great Depression. We're going through the same thing. Everything is cyclical in human life. We can't stop it. It's very cyclical. So are markets. So I want to talk about, first of all, the late Tom Williams. Now, I'm hoping this is going to work, but I don't know. But I want to play this video. And Simon, you can come in and tell me if it doesn't work. But I'm going to play it. And it's going to come over in my speakers. And hopefully you can hear it. If you can't, then we can go. I can just explain it. But I want to, this is the guy that I met by fate, is a good word, back in 1998. And then we formed the company a few years later. And he sold the company to myself and my business partner, Richard, which is Trade Guider, as you know it now. But formerly it was Genie Chartist, and previously it had another name. But it's the same thing. It's based on volume, spread, analysis, which I'm about to show you live. And I'm going to talk to you about a chart that's at the bottom of this website. But if you want to get a copy of my book, you can go to that site. But listen very carefully. This is the Resource Center. You can get the book. There's no charge. Just go there, download the Resource Center. But let's, Simon, see if this works. This is Tom Williams.
Sorry, Gav. Unfortunately, the sound isn't working.
Right. Okay. So the sound. So let me just summarize what Tom was saying there, because the sound is probably not as, it comes over a bit choppy. But let me summarize it, okay? Because I can show you this now. So what Tom was explaining in that particular video was the situation where him as a syndicate trader would go in. He worked in Beverly Hills in California. That's where he went. And initially he was a state registered nurse. And one of his first clients, if you want to call them that, was a syndicate trader. And this syndicate trader became very good friends with Tom and said, do you want to learn and be part of what we do? And they sent him to Park Ridge in Illinois to learn the Wyckoff method, which is what I'm going to show you today. And he then went to that course, came back, and instead of being the nurse for this guy that was a drug addict, he then changed into the chartist for the whole syndicate. So he had a 7-foot ruler, which I've still got. And he would draw charts with trend lines and trend channels and areas of support, areas of resistance. So why is this relevant? Well, I'm going to show you the first story before I get to the live charts. Okay. And the first story is exactly how it played out. If you look back in time, everything that you look in the past will project to the future. It's very historical. Many things like wars and all of these things are very well, people think it's not. You can't project out what's going to happen in the markets, but with volume, you certainly can see something. So I'll repeat again, volume is activity. And, you know, there are millions and millions of traders around the world, including the banks, the institutions, the syndicates, the big money. I think in Poland, they call them grubash, the big fish. They move markets. Some of them are named. Sometimes you hear about Warren Buffett. Sometimes you hear about George Soros. But most of the time, you don't hear who's doing it. But what we can see on a chart is the volume. Now, this is British Petroleum. It's on the volumespreadanalysis.com website, right? Please go and look at that video. Go and have a view of it. And if you've got questions, we've got a live chat area here with Mary. You can get straight in touch with us and say, I've got a question. But the questions will come from what I'm about to show you, which is relevant to now. This, of course, is in the past. You'll say, aha. So what you're doing is looking at something back in 2009 that's irrelevant today, but it's completely relevant, as I'll show you. And it's going to be relevant the next week. So we see the oil spill crisis, right? I was in Boston. I've told this story before on Round the Clock Trader, but I'll tell it again. For those who are new, I was in Boston speaking at MIT, the Massachusetts Institute of Technology. You try saying that. But I was there, Boston Traders Group, lovely bunch of people. And I actually had a phone call the night before in the hotel from Tom. He said, Gav, we need to buy BP, the shares. I said, what? Have you not seen the news? And he said, yeah, I've seen the news. They can't cap the well. I said, well, BP apparently are going to be taken over by Colonel Gaddafi. He said, no. Look at the chart. Professional money are buying. Now, by the way, look at BP shares now and what they've done in the last year. You'll know that you're not being told anything that's going to help you to make money. But lo and behold, I did look at the chart and we did buy the shares. And we can see on the monthly chart what happened now in hindsight. But I'm going to show you UBS. That the weekend, they didn't release the news on Friday. Oh, no. Weekend. We're going to have an emergency meeting Saturday and Sunday. UBS going to take over Credit Suisse. Why not just tell us last week? Because you must have known. No. It all happened over a weekend. If you're naive enough to believe that, you won't make money in the markets. I'll show you exactly what we did. And you'll understand why volume is important. And then I used Tiru's indicator on top of it to project. Now, I can't show you that in this presentation. We haven't got enough time. But Tiru's already shown that. But I know where I can tell with my point and figure charting and Tiru's charting that this is a great opportunity to buy certain stocks, which we're doing in Wyckoff Williams. So let's go back here. Look at the volume on the down bar. It's a widespread, both of these. When we refer to volume spread analysis, we're looking at volume, which clearly here is ultra high. In my book, Trading in the Shadow of the Smart Money, which is on Amazon, which has been getting many sales. I talk about these widespread bars, but it's in an old area to the left where support was found. But that's a monthly chart. So we're going back years. But if you look at the BP price now, you'll see where it is. But most importantly, let's look at something that's relevant today. Okay. Credit Suisse's buyout by Swiss rival UBS results in further panic throughout the global banking system. The news is bad, getting worse. Time to look to buy. As Warren Buffett said, you can't buy something that's popular and do well. What's the most unpopular thing right now? Bitcoin, I'm long. Why? I'll show you. It's all in the chart. So remember this, the chart doesn't lie. Everything that you're about to see is based on very simple universal laws. There's 4 that will make you successful if you understand them. The first is the law of supply and demand. That's what's driving price, nothing else. Okay, you can talk about mathematical formulas, this, stochastic, candles. You get analysis paralysis. We don't do that. That's why we've partnered with Tiru. He talks about the truth of the market. That's exactly why we're working with this team there, because there is a truth, but you've got to believe it. And I know this to be true because of the success that I've had and the people that I've taught. And 2 of our customers flew over from Switzerland and Bahrain in the last couple of weeks and spent time with me in a rather disorganized 17th century cottage. But do customers become friends? Do friends become customers? It's both, in my experience. But customers tend to become friends because they know you're trying to do the right thing, which is what Tiru does. And I can say that Simon is a friend because what Simon has done with Round the Clock Trader is he's giving up his time and his effort and his energies to educating people with the people he selected to come and present. Now, you might not agree with everything you hear. That's absolutely fine. You shouldn't. You should question certain things. That's absolutely fine. And I'm not looking at the questions at the moment if there's some coming in because I'm going to get to the charts because obviously we're limited for time. But the one thing I've talked about, law, supply and demand, but there's some others. Effort versus result is a universal law. It applies to nature. Cause and effect is a universal law. It applies to nature. But there's something that very few people talk about in this business, which is the law of attraction, which is my 3rd book. It's called Think, Link, Create. I've learned how what we think and what we see creates our reality. And that is a very strange thing because I didn't believe any of that when I was a police officer. I saw some horrible things. And I suffered from PTSD, which is post-traumatic stress disorder. Now, going through that process and learning and coming out the other side helped me enormously to understand how to help others. But helping others in the financial world is very difficult because, and it is, there's so much out there. There's so much misinformation. There's so much media about what inflation's doing, what the Bank of England are going to do, what the Fed are going to do. And this creates a feeling of emotion in a trader that makes them, they see a price suddenly rising and they say, oh, that's good. I think I should buy here. When in fact they should sell. And it's the complete opposite when you look at the banking sector over the weekend, which was horrible news that 2 banks in America had gone, and we've got on Monday more negative news. We can see it here, but the chart doesn't lie. The chart doesn't lie. Here is the daily chart of UBS for the last few days. Okay, has that price plummeted on high volume or has it gone up? Well, this is TradingView. This is Trade to Win, which is our simplified trade guider platform with volume spread analysis. And this is what I haven't put Tiru's indicators on here yet, but I'm going to do a seminar, a live trading event with Tiru next week. But I want to explain to you what's going on. Now, one of the things that happens in markets is we've got to understand human emotion. So if the news is telling you the banks are falling, and indeed we even had a signal saying the market's mushrooming over here on the daily chart, we had sell indicators on my Smart Center fund technology saying this is a sell. But ironically, it got down to the low here and we had PB. Now, what does that mean in TradingView? Look, this is what Wyckoff, Richard DeMille Wyckoff, who you should definitely go and Google, discussed. It's called a spring. It's a markdown, gap down often, and the volume, as you can see, is higher than all the other volume bars behind it. We can zoom that in. It closes up near the top. Forget the open. I'm not interested in the open. I just didn't change it here. But then it actually reacts to that. But look at this bar here on very low volume. As the market falls on Friday, the news is coming out over the weekend. Everyone's selling, but the volume's very low. Professional money are already buying. Now we look at the weekly chart. Okay, we've got a very interesting bar that hasn't filled yet, which is why we're not yet ready to add into a position. But it did go up because of these two bars, but then it said PS. But I cannot analyze that bar until Saturday to see if the sellers are in control. And if you click on this button here, you can see the news, which I like about TradingView. Very simple, very easy to use, not expensive either. That's the wonderful thing about TradingView, which is why we're using it in Wyckoff Williams because of this. So we look at these price bars in UBS. Now, the one thing you can do is then go down to a 4-hour chart. And this is a very interesting time frame. Now, what you're going to see on the 4-hour chart is a classic Wyckoff volume spread analysis principle that was backed up by Master of the Markets SMI at the time it appeared. Now, this is a real chart. It's running. Now, do I expect the market to rally massively away from this? Not yet. I believe it's probably going to come and retest into this area. But let's talk about PB and tests. Okay, very important. People can't see the charts, I'm being told. So hold on, let's just double check. I am sharing the screen. Ah, okay, got you. So let's show the chart. I was showing it. Let's just double check. Okay, I'm doing it now, Sam. I figured out. When here it is.
Yeah, I was.
Yeah, that's fine. So let me just share that. I'll just recap on that, and we'll go straight back to the UBS chart. Can you see it now?
Yeah, it's all good now. Yeah.
Okay, good. All right. So just to recap, here you've got your buying. This is a 4-hour chart of UBS. Now, what I was showing, and obviously I think by switching screens it may have caused the camera to go off, but nevertheless it's the same principle. You've got massive volume on the down move here, and you've got a PB on this ultra high volume, which is massive. I call it in my book Yao Ming, which is a basketball player, very famous. Used to play for the Houston Astros, 7'6". But what we see there is the volume. And now you can all see the chart. I can just replay that to you because you're probably looking at me talking about a chart and you're saying, I can't see it. Well, you can now. So what we've got is a gap down bar on very bad news. And again, I won't jump screens for the moment because I'm going to go to a couple of other screens. But there's a principle here that was taught to me by the late Tom Williams, which is very, very important. He said, if the news is bad, and it's getting worse, that's what he used to say, and the market gaps, but the volume increases on the downside with the next bar up, wait for a test, Gav, is what he used to say. Because if the market is going to try and rally, the market will show itself. It will show its hand. It's like poker. Look at the volume on that down bar on the 4-hour chart. Okay. It even says TE, test. that sends me an email from TradingView, which I'm using today. I also use in Wyckoff Williams the Smart Center Pro technology, which I've talked about many times. But when you go to tradeguider.com, you've got Trade to Win, which is our retail side, and you've got Trade Guider, which is for the professional side. You can go to both sites and get pretty much the same information, but pricing is, of course, different because of what we do. Why do you need a piece of software to trade? Right? I've heard some people listening to some of the presenters. Do we need a live trading room? Some said yes, some said no. Do we need software? Well, yes and no. I'll give you my take on it based on experience of 23 years. What computer programs and smartphones are very good at? They're very good at scanning, okay, which human beings are not good at. We're not good at multitasking. Whether we think we are, we're actually not. So when we look at a computer program, what SMI and Master of the Markets have done with their indicator is be able to give the trader the knowledge or the information to say that's where the market's likely to go. It's a bit like a point and figure chart, which I use a lot. But I actually find the SMI indicator from Master of the Markets incredibly accurate to the point and figure projections that I do. So that's the first thing. The second thing a computer is very good at is alerting you, having scanned all these charts, to when a setup like this has appeared, which is what it's done. It sends me an email from TradingView. And it does it from, I use NinjaTrader actually as my other platform, but that's for the Smart Center Pro technology. But Tiru and I are going to be doing a live webinar next week on all of this, so you'll see this. The third thing a computer is very good at is recognizing numbers, or what I call rules. So if you've got a telephone and you want to dial 999, I hope you never have to do this, but you did, and you did 994, you're not going anywhere because you've missed a digit. If you dial 999, you're going straight through to the emergency services here in the UK. It's 911 in America. A computer knows exactly if you've put the right information in it. It doesn't differentiate. It's not like a human being that makes mistakes. It says, if you dialed 911 in America, you'd get through. So these indicators, you can't see them here, but they've got numbers associated with them, which says if that and that and that happens, the market's likely to move. Now, the power of the scanners built into Trade to Win and the VSA method, combined with what Master of the Markets has done, is incredible because it does give you the setups. Now, I urge you, if you're new to this and you're just starting and you think that trading the financial markets is a get-rich-quick scheme, I'll echo what Tiru said. It is not. My first trade I ever took, I lost $5,000. I could afford to lose that. And I always say, don't trade money you cannot afford to lose. And don't think this is gambling. This is not gambling. You're not gambling. You're making informed decisions based on evidence if you know what you're doing. But of course, a lot of people don't do that. And I do know that a lot of people think that, oh, if I start investing in this and doing that and crypto and this, I'll make a fortune. Everyone's telling me a few weeks ago in a webinar, well, we're all going to sell our Bitcoin. Really? Why? The professionals are buying. Look, that's a daily chart of BTC Bitcoin. At 20,000, I was being told, even by my own broker, if you're still short Bitcoin, which I had been, get out. You've got to get out because guess what? It's going to go further down. Blah, blah, blah. And I was like, what do you mean? I'm short. Oh yeah, you are. I said, but no, I'm actually going to buy. Why? Look at this. That's bag holding. That is PB is a confirmed VSA indicator, which shows that the crypto market was being bought. The chart doesn't lie. Everything else lies. I believe that, well, I know that a few months ago, the second biggest crypto market maker went bust. And of course, everyone said it's all going down the toilet. It's not. This is the truth. Look at the indicator, but most importantly, look at the spread of the bar. So my great credit goes to the late David Weiss, who passed away a few years ago, who I spent a lot of time with when I was in Chicago. And he said to me, Gavin, look for the shortening of the thrust, was his word, and the increase in the volume on the down move. You'll see where the buyers, like Wyckoff said, are showing their hand. And that's exactly what we see. So we see 2 or 3 widespread down bars here, here, and again here. And suddenly here we can see quite categorically the shortening of the thrust on the highest volume that we'd seen for many, many, many days. The next price closed higher. Demand is overcoming supply on all this negative news. This is how the markets have to operate. It's supply and demand. We chart nothing more at Trade Guider, and indeed using the Master of the Markets SMI overlaid, we can first of all find an entry point based on volume. I don't care what anyone says about you can't pick tops and bottoms. I can show you, and I will do next week, I can't do it here, all of the scans that we do in the stock market, which we scan for instruments called bag holding. Now, bag holding is a very simple word. What does bag holding actually mean, right? It's a VSA term that Tom invented when he was here with us. And he said, well, Gavin, it's a very simple thing. And I said, well, bag holding, what do you mean? He said, well, very simple. He said, everyone's panicking and pouring their dollars over the top of the market because they're panicking. UBS, Credit Suisse. And the professional money at the bottom are going, look, we've got to catch all these dollars. I'm going to open the bag and catch all this money. Bag holding, that's what you're seeing. It works. And don't take my word for it. Remember, you're the jury. Look at the chart. Did UBS go up this week or did it go down? You decide. Not saying it's going to continue to go up, but there's definitely was a buy opportunity. Did Bitcoin go up this week? Of course it did. It had a bit of a waiver, but you can then go. This is another interesting point. I talked about earlier the Aussie dollar. All right, and this is the hourly chart of the Aussie. Now, I know Tiru looked at this, but there's an indicator here that says this market's going to fall. Not far, but it's going to come lower, which it's already done. And there are 2 price bars I'm going to analyze for you so you can then understand. Now, again, I got an email alert to say this is a short trade on the Aussie based on a 1-hour time frame. And you might say, well, hold on, what about the daily? What about the weekly? Well, I'm not going to show you Smart Center Pro right now. Well, maybe I will have time to do it. But it gives me multiple time frame analysis. Now, I can change on the fly the time frames. Okay, so I can go here to a 5-minute chart and I can see that basically the sellers had come in, fell, and it's coming back in again. Okay, so this is a weak chart at the moment on the 5-minute chart. But going back to the hourly chart for you, because I know you can all see the screen here. This is a very important price bar in a chart. Okay. Now, I can't see the questions at the moment because I'm not going to keep changing screens, but Simon can interrupt me if there are any. Well, we can do question and answers in a few minutes. But I want you to first of all look at the volume at the bottom of the chart and just type in, and I'm sure Simon will agree with this. What do you notice about the volume on this price bar? Okay, it's very important. Okay, and if you read Trading in the Shadow of the Smart Money, you'll understand it. What do you notice about the spread? Now, don't confuse that with the bid-ask spread. It's not. It's the range of the bar, the high and the low. And notice that in Trade to Win, which is our entry-level package, you've got a top and a bottom marked out. So I'm going to give you the setup because that's what people want to learn. They don't want to come here and say, well, okay, you're looking at a PowerPoint from yesterday or BP from 10 years ago. You want to see it now happening now. Well, that is PS, potential hidden selling. It's in my second book, which you can get if you register at volumespreadanalysis.com. You get the book. It's got all the descriptions of this, so you understand it. If that was all buying, as many traders on the hourly chart started to buy, how could it close near the middle with the next bar down? But then there was a test and it rallied so they could sell some more in this bar. And on Smart Center Pro, on the hourly chart, I got an immediate alert right at the top here on a 15-minute time frame, upthrust. Upthrust. What is an upthrust? It's the third highest volume that we'd seen into this area where the sellers were, and it closed on the low. The next bar closed lower, but it was a test of this area and it failed. And that's why this is going to go down the toilet. This is all Wyckoff. And then when I overlaid Tiru's work, I'm using smaller time frames. So that's fine. But you can look at this on a bigger time frame. So you can basically come in here and go to the daily chart. Okay. And what you can see, where the buyers are definitely in play down here. There's no argument. It's the bottom. That's bag holding as well. It picks it up. But now we're moving sideways. So the question and the conundrum, if you want to call it that, which time frame should I trade, Gavin? The 1 minute, the 5 minute, the 15 minute, the hourly? What should I trade? Because you've got on the daily chart a serious sign of strength, which is why it's gone up. But the last few days, it's starting, well, especially today, it started to push down. Markets move on the universal law of supply and demand. Then you analyze effort versus result and cause and effect. So let's go to gold, where I will show you something called a test in a rising market. Now, just to be certain, you can all see my screen. I'm sure, Simon, just to double check, everyone can see this chart of gold, right?
Yes, I can see it. So that's what everybody else will be looking at.
Perfect. Okay. So first of all, in the Trade to Win package, we have a system that measures trend alignment. Now, you'll notice that up bars, price bars that have closed higher than the previous bar, are in green, and down bars are in red. Okay, so you can see them very clearly. Here's what Tom taught me, and I'll put this up on a daily in a minute. But what you want to look for is that after a fall in price, you want to look for buying to come in. And it usually happens on very high volume down moves. And this one didn't produce a signal on this platform, but it did in Smart Center Pro. And this was a bottom. Can you identify tops and bottoms in markets? Of course you can. We call them bag holding at the bottom, and at the top, the end of a rising market. Now, the thing that works is once you've identified it, you wait. You don't go in immediately. We do what David Weiss taught me. We wait for the change in behavior. Now, the change in behavior in this market took a long time, but it happened in here. We had a very high volume up bar, no signal on it, but look at the green diamonds and the green bars. And then there was a test of that area and it continued to rally. And we've done the same thing a few days ago on the Fed announcement. So gold is going to go again to 2000. Now, if you put this up on a bigger time frame, you start to understand why volume is so important. Because here we can see what I call the saucer forming. Okay, so the market had a big collapse, then it found its level, but then I looked at the weekly chart, and that was the key for me, because if I put up here on the auto, what I can see is we're into an old area to the left, which is going to act as serious resistance. And keep this in mind if you're in gold, because we can see two indicators that I did on YouTube. I talked about this in February of last year. It's on YouTube. You can go and have a look. So it's a year old, the video, but I did show this. And there is the selling. And then it rallies 4 weeks later, but there's no demand. Look at the rally, look at the volume. Okay. So let me explain those two signs of weakness to you, because they may well appear again at this level and give you a great opportunity to short gold, especially with Bitcoin rallying. First of all, we notice the PS signal is very clearly on a widespread ultra high volume bar, closing near its low with an indicator that sends an email. So even on a monthly and weekly chart, daily chart, you get it. Do you believe it at the time? Very rarely, because the news would be, oh, gold's going up. It's rallied for 6 weeks. It's going to the moon. Most of the institutional money will tell you that. But what they're doing is encouraging buyers at the top so they can sell to you. And then the next week, we get our confirmation bar. It closes on the low, right down the bottom. Supply has overcome demand. That's what's happened. And then you get something called ND followed by another down bar. Well, that's called no demand. It means, hey, we sold a few weeks ago. We're not buying. But the market makers, they want to keep the price up there for the moment to encourage people to stay in positions. The uninformed, the herd, as Tom called them in his book, which I think is a bit derogatory. I don't like that term. But nevertheless, it's what Tom referred to as the group that are always wrong. Okay, and they say that 80 to 85% of retail traders here in the UK don't make it in the markets because they're following a tunnel, a herd. Don't do that. Tyrrell will never teach you that. I know Simon wouldn't, and I don't. We want to expand your mind so you think, hold on a second. Let's look at the evidence. What do I see? I see a very high volume up bar. The market's moved up on a big spread on a weekly chart. My stochastic says long. My candlestick says long. My moving average says long. Oh, my broker's rang me. You want to be buying this? Look, it's going up. And then it tanks. This is the truth. This is how Wyckoff found this out. And another great trader that you should certainly Google. Well, actually, I'll do it. I'll do it. Let's type it in. So you type in Richard Ney, N-E-Y. Okay, and this is Richard Ney, and he passed away in 2004, and he was very famous. But there's lots of images and stuff. You can type in Richard Ney. You can find out lots. But if you type in Richard Ney, and let's see if it will work. It may not. Rolls Royce. And you will see a very, very great image. Here it is. And let's just pull that back. And there it is. Now, you probably can see that. Hopefully you can see that. But look at a beautiful Rolls Royce. I think it's a Silver Ghost. I'm not sure. But look at his number plate. If you can't see it, I'll show you. I'll read it out. It's W Whiskey, A Alpha, K Kilo, E echo, wake, space, U uniform, P papa. Wake up. Wake up. What did he mean by that? Why did Richard Ney put that on his number plate? Well, very simply, because he, as an individual, lost a lot of money in the financial markets. So I'm going to go back to the euro because I've just had an alert on that as well. That's interesting. All right, okay. He started his life as an actor, very famous in Hollywood, made a lot of money, and then traded that money in the financial markets and began to start losing money consistently. And he couldn't figure it out. He said, I'm not stupid. Why do I keep placing that trade and suddenly it goes the opposite way? And it's very interesting. I've got these books. I've got all Richard Ney's books. I've got all the Magazine of Wall Street books. And the consistent theme, and Ney discusses this in one of his chapters. He talks about the gangster Lucky Luciano, who back in the 60s was granted a tour and he was a Chicago gangster, very famous, granted a tour of the New York Stock Exchange floor. And as he walked around and came out onto the steps, there were press people there with cameras and filming him. And they said, have you got any comments? He said, yes, I've been granted this wonderful tour of the stock exchange floor. And he said, what did you learn? He said, I realized I've joined the wrong mob. True story. Now, what does that mean for us? Us trading, looking at these charts. That's not a conspiracy theory because there's plenty of those around. What we know and what Tiru knows is that if you understand volume, like we can see here, okay, which is the euro is going up, but the buying happened at that price. Look at the volume. Now, once you can scan for this, you can scan multiple charts, which we can do in TradingView. So I can have hundreds of charts scanning. Once I see something going on, and that's an old, because I lived in Chicago, and when I used to go and work in the trading office right next door to the Chicago Mercantile Exchange, as I walked in the office door, everyone looked up and go, hey, Gavin, what's going on? What's going on? That was a very famous thing. And I go, what do you mean what's going on? Nothing's going on. I've just walked in the door. But that's why we don't use the opening price on a chart. We don't need to, because nothing's going on. The market isn't open yet. But when it opens, the activity is coming in. Then we wait for the close. Now, obviously in futures, you get a 45-minute break and then you get into the overnight session. Doesn't matter. The volume's still there. It prints. And it does in stocks. Why do you think the self-regulated exchanges around the world don't release the true volume information till the next day? Because they know how valuable it is. So what volume spread analysis does is analyze the universal laws, the three that drive price. I'll repeat them. Supply and demand, cause and effect, effort versus result. If this was all supply or sellers, the next bar would not close up. Physical, absolutely against universal law. Then you've got SO, which I haven't touched on yet. You've got two of them. These are called shakeouts. And again, like the bag holding signal, I said to Tom, why do you call it a shakeout? He said, I didn't. Wyckoff talked about this term. It's basically pushing price down to panic people to sell, shake them out the market. So almost like turning you've got a pocket full of coins, turn it upside down and shake it. All the coins come out, a shakeout. But if you get a test after the shakeout, which we've got here, the price is going to rally. And then you put the master of the market's SMI on it, which again, I'm not showing on here specifically because Tiru's already said it, but we'll do a seminar next week and show it. You can then sort of start projecting where it's going to go. So I'll give you a projection. I've got a point and figure chart on my other screen here that says the euro is going to go to 1.1000 as a minimum, the round number. Now, the Aussie dollar I talked about earlier, I'll finish with this and then I'll take some questions. But If we go back down to a smaller time frame, okay, so what we've got at the moment is exactly what we'd expect, is an effort to rally into the London fix. The market's moved up, but let's go to the 60-minute chart, which is the hourly. Now, what we can see is a big fall for the last 4 hours and a rally starting to attempt to happen after the test. But what you're looking for now, and this is the key part, is the market to come into this bar here as it tries to push up, but the volume diminishing. And if you see that, because they don't take the market down immediately, professionals don't do that. Here's your buying on the down bars. Look at the volume increasing as the thrust narrows. And it's even got an indicator there, PB, the buying. That was the buying. You've got another one here. And then just before the rally, there's a test. Up it goes. Obviously, this is in the background. So that is going to act as serious weakness in the future. So if you want a trade setup, and I will say what I'm looking for, will be a breach and this can take 2 or 3 days of the low here and then moving lower. And finally, going back to UBS, what we can see here on the 4-hour chart, this is going to come back down because there is a lot of sellers still in play here. But is it a good buy for the future if it changes behavior? We'll simply go to the daily chart. And I've got a trade alert set for when it comes back and takes out that top there. So where that high is at 20 would be, for me, and we're not going to add to any positions here, that would be a good trade. So with that being said, I'm going to just finish off by saying thank you to Simon and the whole team there. I think they do a great job, and obviously these events, I hope, are giving you some information that maybe you are not aware of. Our website, which is our sub website, basically is tradetowin.com. It all works with TradingView, which I'm using. I'm paying $400 a year for their premium package. It's next to nothing. We plug into it. Tiru's SMI plugs into this as well. There's videos that you can see on what we do. And most importantly, this works with pretty much every market. They cover a hell of a lot of markets: stocks, futures, forex, crypto, the lot. I can put up any chart, and I've got all the data. And then next week we'll do an event. So Simon, I'm going to hand back to you, and then let's see if there's any questions for the last minute. And Tiru and I think are here. We'd be happy to take them because I can't see them at the moment. So any questions, happy to take them. Let me just put the, hold on. I can't hear you. So just one sec. Yeah, put your mic on, Simon. I can't.
Yeah, that's right. Yeah.
I thought that was my fault. I couldn't project the screen, but anyway, I hope everyone enjoyed that. I couldn't see all the questions, but if there's any,
thank you. Yeah. So the kid's back. Hi there. How are you doing? Anton's here as well. Just in revert, Anton's following the BAC JPM shares. There was not enough short gold. Does that make sense to you?
Yeah. So you're talking about Bank of America, JP Morgan. The banking shares, I could have shown that, but I didn't have time. But you've seen UBS. So basically, there is a bit of a rotation going on right now. Gold is rallying, but it's coming up on very high volume, so be careful of that. Bitcoin is rallying, which we can see. Just be real careful now about the banking shares, because at the moment we're sitting tight, watching what UBS have done. And it could be more bad news coming, but it's going to come probably Friday, tomorrow. So just be aware, though, if there's going to be bad news, they're going to do it over the weekend for certain. Just want to say, VSA does work, just takes time to learn, says Paul. It's interesting. It does take time to learn, and I won't say that's an incorrect comment. It's a bit like me playing golf. Okay, I've given up, by the way. I'm throwing my clubs away because I'm rubbish. because I brought all the kit. I brought the ping clubs. I had all the kit. I've got all this. This is a golf shirt, by the way, that I'm in right now. Very nice, expensive one. But I couldn't hit the ball because I didn't practice. And this is the thing with trading.
Looking good there. You like all the gear, right? I know.
You can have all the gear. You can have a lovely house. You can have a lovely view. But you go on a golf course and you realize how rubbish you are compared to the professionals. Look, in this business, I'm good at trading. I know what I do. And I know that I can help people, and money can be made in this business if you do three things. The first one is discipline. The second one is timing. And the third one is belief. You are the Holy Grail, no one else. And don't think anyone else that's teaching you is the Holy Grail. You've got it. Just find it.
Okay, totally agree on forthcoming short goal, waiting for weekly stock to top out.
Yeah. Okay, I'm seeing that.
How
How much subjective personal experience in your system versus just relying on your indicator? Both. That's a great question. Yeah, both. So I use the system to find the trade. I use my experience and my learning to execute. I still use the human being and not the computer, although we are programming it in a different way. And a visual person, and you've joined the trading room, great. That's the best way to learn. I go into the trading room pretty much all the time. Visualization is very important, definitely. And again, finally, before I go, Simon, thank you very much indeed for putting on these events. The Round the Clock Trader Summit, great job, and looking forward to seeing you in London at the end of April.
My pleasure, Gavin. Yeah, always a pleasure. Thank you. And we're right out of time now, so
yeah, that's right.
Move on to the next thing. Take care. I'll be in touch soon.
Thanks, Simon. Thanks, everyone. Namaste. Take care. Bye-bye.
going to move upwards without a great deal of back and forward that can stop you out a dozen times and leave you with a hairstyle like mine, you know. So what makes up value? Well, earnings, inflation, and interest rates. And if you go to vectorvest.co.uk, there's a book there called Stock Strategies and Common Sense. And Bart DeLito, who's the founder of VectorVest, who would, I think, loosely describe himself as a fundamental analyst, he shows you how he goes about valuing a stock. All right, so the sums are all there. So at VectorVest, if I can get my pen out, we want to answer 3 questions. What's a stock really worth? And we want to favor undervalued stocks. How safe is it? How safe is the earnings stream? Now, these 2 are fundamental measures of the company itself. And then when to buy, sell, or hold. Is the darn thing rising? Is it going sideways? You got to sweat it out. Or is the darn thing falling? Buy, hold, and sell. And this is clearly a technical measure of the direction and momentum of the share price itself. And as I say, everything in VectorVest, we want to try and put both together. Some years ago, a very, very good friend of mine, a guy called Zach Meir, who's well known in the UK stock market circles, he said that VectorVest is the best of both worlds, the best of fundamental analysis married with the best of technical analysis. So we put a value to every share every single day, and I'll show you that on the program in a second. Secondly, we look at a measure of the future, and we look at a measure of the future of the long-term share price appreciation in relation to what a corporate bond will pay. Now, for long-term, read 3 years. And relative value measures how much the share price will rise over that 3 years in relation to what a corporate bond will pay in the same period. And it's quite a complicated calculation. It incorporates earnings flow that we buy from the world's top provider of such a company called FactSet. If a company has got a relative value of greater than 1, it's outperforming a corporate bond. So RV less than 1 is not great, folks, because you're underperforming a corporate bond, and that's not a great place to be. Greater than 1 is not bad. And I've shown, our customers have shown that there's relative values above 1.25. That greatly helps your portfolio to produce results. At 1.25, it means that the share should outperform a corporate bond by 25% over that window of 3 years. Now, in my own investing, I'm primarily looking for undervalued stocks, and I'm always looking for a stock with an RV of greater than 1.25. There are exceptions, maybe for a 3-day trade. If I see a momentum building up, I'd be happy to trade in a stock with less than 1.25. But if I'm holding it for any more than 3 days a week, then I want that earnings growth at my back. So we're into our little talk by 2 minutes. I want to find an undervalued stock, and VectorVest gives us a value every single day. I want to have a relative value that's greater than 1.25. It drives the share price. The next measure is called relative safety, or RS. And this measures the consistency and the predictability of the financial performance. Now, again, to come back to that young man, if the RS is relatively high, there are few mistakes in the company. So the algorithm looks at the balance sheet, the income statement, the cash flow statement, all those ghastly ratios, and makes a judgment as to whether they're getting better or whether they're getting worse. And on a scale between 0 and 2, an RS of less than 1 is not good. It's saying that these numbers have been up and down, in and out. that could be a great swing trade. It could be a great short-term trade, but if you're holding it for any period of time, or if your objectives are a retirement portfolio, well, you don't want to be there. Just too many surprises. If the RS is above 1, well, that's not bad. And if the RS is greater than 1.3, this is a company that's making money, pays the dividend, has a history of growing that dividend, and the financial situation is pretty sound. Now, it depends who you are and what your objectives are as to which RS you choose. If you are aggressive and you can manage stop losses and you've got a history of taking stop losses without fear or hesitation, then certainly you can bring the RS right down to much less than 1. If you play a lot of golf, if you go on an awful lot of fishing trips and you want to look at your portfolio once a month, my advice would be to push the RS above that 1.3 level. Then the portfolio will largely take care of itself. I would presume that the people that are listening in here today are pretty experienced in taking stop losses. Certainly if you're in the Forex market and you can't take a stop loss, my word, you're dead quick. So I would presume that everybody's got that proven discipline.
David, can I just ask? There's a question from the kid, and he's asking what you mean by swing trading in stocks. What kind of time frame are you trading, and what is
3 days to a couple of weeks of that order?
Correct.
Could go if the stock is running. You could let it run for 6 weeks with the trailing stop. Okay, does that help?
Okay, I think that's Thank you.
And then the third metric is relative timing, which is a measure of the trend. That's the easiest one. And on the trend, relative timing less than 1 simply means the stock is falling, and greater than 1 means it's rising. And the further above 1, the faster it's rising. And then what Bart Toledo did is he put all 3 things together into the master indicator VST, which for the first time in my experience, in fact, put together relative value and relative safety, and which are fundamental measures of the company's performance, together with relative timing, which is a technical measure of the share price. It incorporates both fundamental and technical analysis. And as a default, we sort all of the shares in the market by descending VST, because that's where the winners are. So we put a stop loss to every share in the market every single day. And certainly when the share falls to the vector best stop loss, well, you need to be thinking long and hard as to why you're holding it. Sometimes if you're a swing trader, you could actually have a tighter stop loss than the vector best stop loss. But nevertheless, the vector best stop loss acts as a line in the sand. Okay, it's a 13-week moving average, 65-day moving average of the closing price. It's adjusted for 2 things. It's adjusted for the volatility of the stock, and it's adjusted for the fundamentals. If the fundamentals are good, RV and RS are high, we widen the stop loss. We give shares with good fundamentals more room to move, more wiggle room. And finally, we put a buy, sell, or hold to every share in the market every single day. And certainly a hold turning into a buy is a great, great opportunity in the marketplace. So that's the VectorVest system. Now, I hope that when I go out of the PowerPoint, I don't have to discard those, that I don't have to, in fact, if I go into VectorVest now, Simon, can you see the VectorVest screen now?
We're looking at the home page, the color guard, yeah.
Yeah, okay, you can see that. That's great. Okay, so this is the home page of VectorVest, folks. And I'm going to try and explain what this is all about in a second, although I haven't got much time. If I click on viewers, this is, I'll make it a bit bigger. This is all of the shares that we follow on the UK market, 2,068 stocks. I've loaded the top 50, that's all, and these are in fact sorted by VST, value, safety, and trend. Now, 4Imprint is at the top, and I have a position in 4Imprint. I've had it for a very long time, and it's a part of the Monday afternoon portfolio that I manage. It's trading at 49. VectorVest believes it's worth 32. And when I bought into it, it was about 32, slightly above 32. But it's run quite a way. So it's trading above the VectorVest valuation now. However, if we look at the VectorVest metrics, we can see that the RV is 1.66. So although the share is trading above its valuation today, over a window of 3 years into the future, we believe there's a lot still in the tank. The relative safety is 1.44, which says that these numbers are really, really great. And the RT is 1.29. So both the technical position and the fundamental position of this stock is looking really great. And it's on a buy recommendation. There's the stop loss at 44. And across here are dividends and market caps and lots of things. It pays a dividend. Really good dividend as well for a reasonable stock. So I'm holding this, and I've held it for quite a while now. So more of a position trade for me. So if we get rid of the valuation, and that's the stock over the last year, and I'll put on earnings per share. Get rid of the stochastic for a second. Get rid of volume. That's earnings per share. Up here is the buy signal. That's the initial buy signal on the stock. I didn't get that one. Probably should have. That was last July. And unfortunately, folks, in last July, Simon, I spent my summer holidays in Tooting, South London, at St. George's Hospital. But I missed that one. But then it pulled back, and those of you that are technical traders should in fact recognize this bull flag pattern. It then gapped out of the bull flag pattern. It went to a buy, and I'm holding the stock. I actually got into it before it broke out of the pattern, and holding it from about 35, and it's now at 49. It's not 2020 or 2021. We were spoiled in 2020 and 2021 in the stock market, but nevertheless, it's going the right way. Those of you, again, that are technicians will know that this is known as the flagpole, and that normally repeats. So in the short term, for a swing trade, it's starting to get quite high in the range. VectorVest says that if you're a position trader, you should be holding this because there's an awful lot still in the tank. So I'm going to be showing later on a very simple mechanical swing trading plan that anybody can make money in. However, if you are a reasonable technician and you apply some very, very simple technical analysis to a high VST stock, such as a gap out of a bull flag, which is trading 101, you're going to make money. Okay, and that's something that you can easily fit in around fighting with the Forex market, I assure you. In fact, as long as you look at it every couple of days, that's more than sufficient. So I'm still holding that. What else have I got a position? Jet 2, I have a position in. It's trading at 12. We believe it's worth 16, so it's still undervalued. The RV is 1.54. That's saying that we believe it's going to outperform a corporate bond by 54% over the next 3 years. That's quite compelling. That's a really great number. Now, the RS is not great. And you've just got to look at a airline. During COVID, they got absolutely and utterly annihilated. So the RSs, the books were awful. The shareholders of the Jet2 took a £500 million haircut. They just wrote off the debt if you examine the accounts. So RT is 1.41, and the VST, which is RV, RS, and RT together, is 1.33. It's on a buy. That's the stop loss. And in fact, GRT is our best shot at the earnings growth next year, 38%. That's quite something. Clearly, there's a few people going on holiday. I've never flown with them, but my brother was on a skiing holiday with them to Bulgaria last week or the week before, and he said they were great. The chap who runs them is quite a character, to say the least. Again, folks, this is earnings per share, a really, really important number. And earnings per share started to motor up in this period. Now, as always, the market will move ahead of that. So the insiders got a sniff. Again, if you are an expert technician, you should see the falling wedge. It's a textbook falling wedge, or what some people refer to as 3 drives to a bottom. I didn't get that, although I should have. The buy signal came in just there. VectorVest buy signal came in just after it came out of the falling wedge. And then the little bugger went into another bull flag. That software of Simon's gets in the way of the screen. And it's pretty textbook. Wave 1, 2, 3, 4, and 5. Simon, they say that you need a couple of glasses of Scotland's finest product before you can see the waves within a bull flag. And it's moved up very nicely indeed. I'm still holding that position, still on a buy. But there was lots of smaller swings that you could have traded in here if your game plan is 2 or 3 days. It's some of these stocks, they're not that liquid to trade them over 2 to 3 days. But that's been quite a nice trade. It's gone from £10, went up to £14 in 2 months. So that's a really good swing trade. So those are 2 positions that I've got. We put on the valuation. There's the VectorVest valuation, saying there's still more upside in this yet, but it's come a long way. And with any luck, it's going to go from here. It's pulled back into this range. I was expecting a little bit of pain down to that high, but with any luck, it's okay. The general market doesn't look good. So that's 2 positions that I'm holding to give you an idea that you don't have to, in fact, do a great deal of flashy. You really don't have to do anything that's that groundbreaking technically to make money, as long as you're in the right stocks, putting together strong growth fundamentals with fairly simple, straightforward technical patterns that would get killed in the more competitive market. Absolutely nailed in the more competitive markets of Forex and stock indices. Work really well. Kitwave's another one, undervalued. I haven't got this one, but many of our customers have. Undervalued, RV 1.43, RS reasonably good, and we put on the chart, and there's the chart, folks. Earnings per share are rising. That's the engine that's driving the share price. It then makes this textbook cup and handle pattern. All right, there's the little handle, and handle's in fact a falling wedge, which is bullish, and it broke through here. There was the first buy signal of this down here, but most of our members in fact got in at that 180, 190 level and rode it up very quickly. Now, there was a really good swing trade. The young man I asked about shorter term trading. Just remember that my old rugby coach used to tell us, let the ball do the work. Sometimes just sitting back and doing nothing and watching the best ones go is where most money is. But this pulled back to here. Now, if I put volume on here, folks, we get a really good. You see how, let's get the earnings per share off. You see how this moved up on rising volume, and then it pulled back on no volume at all. And then all of a sudden, volume came in, and that was saying, I want to go again. All right. So that was pretty straightforward. From 220 to 280 would have been a great trade. I know they're always easy in hindsight. I didn't take that one myself, but that was pretty straightforward using volume. And if you find that I'm, in fact, talking out of Mongolian at some stages, I do a weekly webcast to the VectorVest regulars, and I'm pleased to say that most people are making good money out of them. So that's the third stock that's done very well out of the top VST stocks recently. Been waiting for a bottom on Tongela, still hasn't come. So it's got a RV that's off the chart, but people don't like it because of cyclical nature of coal and the inability of the South African railways to get coal to Richards Bay. Tongela is the old AmCoal, Anglo-American coal, that Anglo had to relist under a different brand some 18 months ago. And hopefully you made some good money. We're waiting. I'm going to show Tongela in a second, but I need now to move to the general market. And again, to come back, this darn software gets in the way. To come back to that young man who asked the question about markets moving smoothly. If the fundamentals are good, if the technical picture looks good, and thirdly, if the overall market is moving, then the probability of a trend goes up. VectorVest believes in buying rising stocks with strong growth fundamentals in rising markets. And we can turn the whole thing on its head for shorting stocks. Well, I'm not going to talk about that today because the FCA gets a bit angsty when I talk about shorting stocks, because you need to use derivatives for that, because unless you've got 50 million in your stockbroking account, the broker's not going to chase around for script for you, I assure you. So the broker will tell you, open up a spread betting account or a CFD account. And with that comes leverage, and the FCA get angsty about that. So I believe that 70% of the exercise is getting the overall market right. If you get the overall market right, then it drags pretty much everything with it. And if I've said that to the VectorVest regulars once, I've said it 10,000 times over the last few years. So VectorVest has been timing the market for a very long time, 30 years, and we've perfected several systems that identify market trends objectively. No scratching your head, counting waves. And that's since COVID, folks. That's the longest term measure of the trend since COVID. We were out in COVID. I was buying in pretty much 3 years ago, right at the bottom here. And people were laughing at me. They were sending me emails that I was, well, some fairly graphic emails that I was a complete idiot for buying into markets. So the very first stock that I bought down here was Lion Trust Asset Management. I bought it at about £9. It went to £25 in that move. And then I gave it all back again. Now, we got a sell signal here. Now, the sell signal doesn't mean you sell your stocks. It just means that be careful about buying any new stocks, because the general market is selling off. And that big bar that occurred where my cursor is now, that was the Pfizer vaccine coming out. And then we ran, and then we went into what one of my favorite technicians, wrong one. One of my favorite technicians, a guy called Richard Wyckoff, would have said that the market fell through the ice. Okay, this is a classic distribution pattern. And then last year we went into this bear market, which was difficult. As you can see, the rallies were small. This has been the longest rally we've had. And about a week ago, that turned down. So as we go into the trading day, the longest term measure of the trend on Vector S is down, and the medium term measure of the trend of the UK market is down, and that's the same in the US. So we have to be very careful in buying stocks at this time. I don't know what the S&P. S&P's sitting up at 4,000. That's exactly where I expected it to go. It's 62% of yesterday's down move, believe it or not, for those of you that believe in Fibonacci. So that's exactly, and cooled up. If you're still listening, sir, in the background, my spread betting company should have closed out the SPX trade at 4,000. That was my limit order on that this afternoon. Our systems are totally rule-based. And that's the front page. And I showed you the front page of VectorVest a second ago, guys, but that's the front page of VectorVest. I've just snipped it out so it's a little bit bigger. And we can see on here that, first of all, VectorVest advocates caution. Now, what's happened here is that yesterday, the shortest term measure of the trend on VectorVest turned up. But the underlying trend is down. Day before, we're in a down-down situation. Now, the reason it's done like this is that I know you're going to find this hard to believe, but there's lots of people out there who simply don't like charts. I know in a webcast like this, everybody, all your customers, Simon, are going to shake their head. How could people not like charts? I assure you, there are hundreds of people out there who don't like charts. So what we've done is we've digitized into 3 words the position of the market. And today, the short-term trend is up, the underlying trend of the market is down, and the longest-term measure of the trend on VectorVest is down. And that shortest-term measure of the trend would be a very aggressive signal that I personally don't take. In the American market, going into the trading day, we've got exactly the same thing. Short-term trend is up, underlying trend is down, and the longest-term measure of the trend is down. Now, this should be used for position traders, and I'm going to show you what I use now for swing trading. It's a medium-term market timing system. It's called the DEW, and I'm going to spare you the acronym. Americans love their acronyms, and it's called the market very well indeed. That was a sell signal here, and certainly you could have shorted the market there if you've got a CFD account. Now, this was this really nice run up in July and August, where I was unfortunately on my back. This was a great short down to here. Lovely 5 waves in it as well, those of you that are Elliottician. This is a very tradable move, and you can get an idea. That young man who asked about how long do these trades last, you can get an idea from this chart, sir, of how long the trades would last. Does that answer that question, I wonder? And then this was the longest one that we've had in quite a while. And then all of a sudden we got a bad one where it got us in and then got us out again. And today, the DEW market timing system is down. And that's the system that I personally use for swing trading in stocks. And I'm not buying any new stocks until that turns up. Now, the methodology behind it is relatively simple, but I've only got a few minutes. It's objective. Those little blue and red triangles, they do not repaint. In other words, you don't get a green one one day, and then you come back 2 days later, the market has changed, and the green one goes away. It doesn't do that. Once they're there, they're always there. So there are dozens of pieces of software out there that, for example, when that system, when we got a green one there, and the market, in fact, didn't work out, it would get rid of the green signal. I remember buying some stuff called, 25 years ago, called OmniTrader. And I thought I was going to get rich in a fortnight. I bought because of a little green signal. And And when I checked a couple of days later, the green signal had disappeared. Oh, I was upset. And they wouldn't give me my money back either. So they do not repaint. And that is whipsaw, folks. And if you're a short-term trader, and that's clearly where that question came from trending markets, the ordinary people have got two boundary conditions: death and taxes. As a trader, you've got death, taxes, and whipsaw to take account of. So that's Jet 2 again. Now, Jet 2, I've added the confirmed call signals, the longest term measure of the market. And that came in just here. So when you've got a company that's undervalued, growing earnings strongly, that goes on to a vector vest buy signal, in other words, it's trending up, and the general market is giving you a buy signal, that's what happens. As you can see, these ones didn't work out, largely because the market didn't work out. As I say, I only bought in here, clearly sleeping. So that's all three things put together. So I hope I've answered that question for that young man about how to find trending markets. First of all, they all have their moments, but if you combine the fundamental position of a company with a strong technical breakout, and 70% of the exercise to get yourself a decent trend is the overall market itself. And then all you've got to do is to sit back and let them run. And that, of course, is really, really difficult. And when you're at the top of your game, add as it moves your way. Okay. And you may have read my dear friend Tom Hogarth's book, where he shows you how to add to positions intraday. Tom and I worked together. We worked on that particular methodology 15 years ago. Adding to winning positions is what you do when you're at the top of your game. Easy to talk about, much, much more difficult to do, because there's a wee devil on your shoulder shouting at you all the time. Take the money, take the money, take the money. We become optimistic with losers and we become pessimistic with winners. And to become a consistently big winner in the stock market, in any market, I don't care what market it is, you've got to examine your own thinking, and you've got to become very quickly optimistic in a winning position and pessimistic in a losing position. So my challenge to you, whatever market you're in, on your next trade, just sit back, take a deep breath, a couple of deep breaths, and just examine your thoughts. Are you optimistic in a winning position? Or are you optimistic that a losing position is going to turn? So what shares should we buy? Well, we have a thing on VectorVest called UniSearch, and I'm running short of time, which will allow you to put any mixture of VectorVest metrics together. And this is a simple one called Superstars. There's dozens of these things pre-written. Now, Superstars finds a stock that's growing earnings at greater than 20%. The relative safety is on the safe side at 1.25. Shouldn't be many mistakes. Relative value, saying that it should at 125 plus, greater than equal to 125, it should outperform a corporate bond by 25%. It should be above 50 pence. So I've excluded all those little AIM stocks. And I haven't mentioned the comfort index, folks. The comfort index is the long-term trend. And the comfort index, at least the long-term trend, should in fact be above 1. In other words, it's got its head above water. And I'm sorting those by VST, bringing the top VST stocks to the top of the pile. And as you can see, 4 Imprint is there. All right, Bango, Franchise Brands, NatWest. NatWest pulled back to a very good level and was hit hard during the week at a 78% retracement of the last pullback. 78%, a very important Fibonacci level, square root of 0.618. I really like the level on Beasley. Although it's on a sell signal, there's nothing to do because the general market is falling. When the general market is falling, I'm personally not buying stocks. You can do what you want, but I'm personally not buying any stocks. Beasley, I'll have to wait for it to turn, but it really looks very good at these levels. Cerillion also looks exceptionally good at these levels. Would need to turn to a vector S buy, so a little bit of waiting before that. As you can see, all of these are growing earnings strongly. And again, all of you that are fighting with the Forex market on 5-minute charts, on whatever, you can do this without affecting that in the slightest. So let me come on now to something which is a sort of trade. You remember the old thing, paint by numbers? Well, this is trade by colors. And it was put together by VectorVest in the US. And I must admit, when I first saw it, I said to myself, well, this is a bit naive. It will, a lot of people will laugh at it. But I've taken with this, I've taken traders who were consistent losers and had been consistent losers in the stock market for 30 years and made them profitable with this technique. So just remember, folks, we're not in the game to prove ourselves clever. We're in the game to make some money. I hope everybody would agree on that. Are we in the market to make money, or we're in the market to solve a puzzle? Recently, I had one farmer down in the north of Somerset, in a place called outside Minehead. And he'd been in the market for nearly 40 years, the same length of time as I have. And he's never made a single, and he keeps feeding his account. And he's always been buying at tops and selling at bottoms. When it's time to buy, you won't want to, folks, always. So, and with this technique, over the last 6 months, he's now making money for the first time in nearly 40 years. So let's have a look at it. It's the VectorVest RT is a noisy animal. And what we've done is that we've used a 40-day moving average of the RT, which measures quite a big cycle. The VectorVest stop loss is a 65-day moving average. And we've taken a moving average of a moving average. So we've taken a 40-day moving average of the VectorVest moving average, of the VectorVest stop. So it's a moving average of a moving average, which smooths out the data. So that's Tongella. And I'm very positive on Tongella. Those of you that are Fibonacci experts will know that that is in fact a very important fib level that I'm hoping will hold. As you can see, there's lots of red here, and that was a short the whole way down here. Although the fundamentals were so good on it that I certainly didn't short it myself. Again, those of you that are technicians, you should see the falling wedge here. So I'm actually quite positive about this turning around, although we haven't got a signal yet. So that's the raw chart. You can see earnings per share growing nicely here. It's on a PE of 2. In other words, you've got to pay twice its earnings. It's on a dividend yield of 43. So now this is what happens when we put on the near perfect indicator. I think you can see the price. Now, the moving average closest to the price is a 5-day average of the VectorVest stop, which is in fact itself a 65-day moving average. And the moving average furthest away from the price in this case is a 40-day average of the VectorVest stop. Now, somebody clever across in the US, if the short one's above the long one, it means that the trend is up, and they've shaded the area between that blue for good. When the short one falls down through the long one, clearly the trend is down, and they've shaded the area between that pink or red for not good. So that's the first thing. The second thing is momentum. And the VectorVest RT is very noisy, very sensitive. So the pink-ish line that's moving on a big cycle is a 40-day moving average of the VectorVest RT. And the green line is a 5-day average of the VectorVest RT. And when the green line goes up through the pink line, and we're in the blue, that's a buy signal. Okay, simple as that. Now, I've been using this as an example on Monday afternoons, and the darn buy signal wouldn't occur. I thought it was going to happen here. So the green crosses up through the pink line just there. So momentum was good, but this thing didn't go blue in between. The moving averages didn't cross. So I didn't get a signal there. So I'm still waiting, and I'm optimistic here. But for a signal here, these two have got to cross, and we've got to search for that. And this must go blue. And that's the simple paint trade by numbers technique. It's very simple. Now, clearly, when this is red between them and this crosses down, that's a sell signal. That's a shorting position just there. So that was a short from just here. Although I personally wouldn't short a stock with really great fundamentals. There are lots and lots of searches on VectorVest to find stocks with lousy fundamentals. So I'm still waiting for a signal here. And similarly on Serica. This was a buy signal just here. See, it goes just there. That was a buy signal. Lovely move up here. Momentum crosses down here, and it goes nice and red there. That was a short. And that, if you'd held that, that short is still in place. Again, I'm quite optimistic about Serica. There's a fib level there. There's a 78% retracement there. But these two need to cross, and this has got to go blue. Now, as I say, I thought that that was going to be too simple, and people would laugh at me when I actually talked about it, Simon. But I have taken 100 traders that were consistently losers. I showed them that technique, and I've turned them into winners just by following that. Now, that may not be for everybody, those of you that are experts, but my word, it will show you how to consistently make some money and also give you the time to trade Forex or whatever you want to trade. So that's Jet 2. And Jet 2, there was a signal. Now, there are signals and signals because this crossover was preceded by divergence, and that adds to this signal. And again, if you come and listen to me on Monday afternoons, I go through that in a great deal of detail. This is normal divergence. The price is falling. The RT40 is rising. You get a crossover here. This goes blue, and that was your signal. That was the initial signal just there. Okay, we're still blue here. Now, your exit rules, if you were just trading momentum, you would have got out just there. But the most profitable exit rules are just hanging in. And I think that that's just about to go again. So that's Jet 2. This is, I hold a position in Jet 2. Hostile World, I've also got a position in. There's the crossover, and it goes blue here. That was the buy signal just there, and I've held that the whole way up. That's been a great, great trade from about 90 pence to 140, 150 or so. And again, this is still blue here. This signal is preceded by reverse divergence. That's another type of divergence for you to get your head around. Not that well known in the community, but maybe in a grip like this, you'll have tripped over. Some people call it hidden divergence. That's Rolls Royce. Oh, just a beauty, absolute beauty. And there's the crossover. We go blue here, and that's the signal. And we go then here. We have got one young man in our group called Phil. Very, very diligent trader, and he's been long of this thing the whole way up here. Looks to me as if there's an awful lot more to come, because to me that looks like a little flag pattern here. I would expect that to burst out of that. So Rolls Royce still looking very good. And this is the ME group. Crossover here, and that makes its way into the blue, and away she goes. Okay, away she goes. This is in the States. This was a great spread bet in the States on Tiki tankers. Crossover, this goes blue, and in fact, away we go. That's reverse divergence. So that's a very simple technique that will make anybody money. And just remember, the objective of the exercise is to make some money, not to make ourselves feel clever. So the easiest way to make consistent profits is to start with a simple but effective trading plan. It doesn't have to be complicated. If I run out of time, is that the bell?
Yeah, if we could wrap it up, maybe just another 1-2 minutes.
All right. So I thought I'd be back at school there for a minute. So.
Thanks.
It doesn't need to be complicated, and the near perfect indicator can be that plan. As I say, you can search for the crossovers, and on a thing called Unisearch that I showed you, you can search for the crossovers, and that layout that I just showed you is a standard layout in VectorS. You don't have to create that from first principles. You just go to stored layouts and press the wee button, and it's there. Okay. So if you're interested in a 30-day trial, it's a full working trial of VectorVest. If you go to vectorvest.co.uk, it's £5.95. All right. After the 30 days, if you're happy with us, then it's charged at £49 a month. If you're not happy with us, then just stop it. Okay. It's on a month-by-month basis, and my promise to you is if you can't make money, if I can't make you money, then you can stop it at any time. With that, you get all our training courses, my webcast on a Monday afternoon. We have a young man in the US who looks at the American market on a Thursday, Glenn Tompkins. And we have a UK user group once a month. We have an international user group once a month, and lots and lots and lots of training on the VectorVest University. That's, in fact, a part of the product.
Fantastic. That link is in the chat box there, folks. Take you to the website if you want to take David up on that offer for the 5-week trial. 30-day trial, sorry.
Yeah, 30-day trial. Any questions, Simon, before we sign off?
We don't have time. There are a couple simple and effective, very nice presentation. Have you got a website? We covered that. Do you use Wyckoff? I don't think you do volume analysis, do you?
Well, I use volume. We use volume analysis. I speak about volume on Monday afternoons a lot. I know as much about Wyckoff as anybody in the world. And I've studied the dear boy for about 30 years now. I have his original course signed by Richard Wyckoff himself, believe it or not. In his own handwriting. And I've been offered many thousands of pounds for it, but I haven't parted with it.
Okay. Well, then, David, I think we'll wrap it up there. Thank you so much for that. We will see you again soon. I appreciate your time this afternoon. Simple and effective. Very nice presentation. Thank you, says Paul. Nice presentation.
We'll see you, Simon, at IX at the end of next month.
End of April. It's rapidly approaching, so look forward to that. Yeah. Great stuff. Take care of yourself.
Cheers, man. Take care. Bye-bye.
progressively, not like a very steep decline, but you can feel the difference. So the expiration is still the same, 4 months ahead. So we are in March, so we are choosing an option that will expire on the 3rd Friday of July. In between, option trades like crazy, goes up and down, right? And it has certain characteristics. So say we buy an option, whether put option or call option, betting on the upside or downside. But if we are now in May, it means there have been 60 days that have gone by. And my option, bar anything else. So anything else, the market hasn't moved, the volatility hasn't gone up, nothing at all. Only the days have passed. And the option has lost a little bit more value than it was at the beginning. When we go to 60 days, you can see that from here to here, things start to get nasty. So if you had an option that you paid for $1, now this option costs less than 50. Yeah, because that has started to get ugly. The problem starts here when you have 30 days. So come end or mid-June, and you only have 30 days left to these options lives. So while you bet on something, you can see that this curve has started to fall, and it has started to fall aggressively at a very big rate, which means that your option now has lost more than 65% of its value, and the real party starts within that last segment where things really get bad. So you have an enemy. The option will actually lose value and tend to go towards zero while you hold it. So you might end up being correct in your prediction, but lose money because the option has lost money. So why am I trying to say here? While options are wasting assets that are very bad for someone to hold them, it's very good for someone to sell them, right? So we act here like the insurer. You actually bet that 99% of the people who will buy the insurance will lose their money, because that's how human psychology is. And you, the guy who sells insurance to them, you stand to make 99 out of 100 times money, right? Which is what we want to do here as well. Of course, markets have a life of their own, etc. But we really want to act like the insurance, like the casino, if I may. And that's why I do that, because we're not a casino. It's not about gambling we're doing here, but the casino is not trading directionally, right? They don't care if something goes up or down. They just care for you to go there and stay there, because they do make 5.27% every million played. So they don't care about you losing or making money. They care about many people staying there. So for every million, they know for sure they will make X amount of money. I'm talking about the American roulette, because they've got the 2 zeros and 1 0. That's pretty much here. We're trying to get the positive edge, right? The positive mathematical expectation, because when we try to predict the market, we are falling into the same problem as everybody. We are trying to predict the unpredictable, especially lately with power and all these things, black swans around us, right? So instead of trying to predict and falling within these 90-90-90 rule that I typically say, which is 90% of the people who actually trade newbies or a little bit more advanced will lose 90% of their money in just 90 days. And why do they do that? Because they go with technical analysis, with a little bit fundamental and RSI and MACD and everything. So why does it make it different from everybody else, the millions of traders? Nothing. You just stand and think you're better than the other guys, and think that technical analysis and levels you can tell better than they can, right? Which is perfectly okay if you can do it. But options are here to tell you, hey, I don't want to try to see where something is going. I'm trying to predict where something is not going. And this is entirely different. Why? Because if I say that Apple is not going to go above 150, it means that if it stays at 150, I make money. If it falls a little bit, I make money. And if it falls a lot, I make money. And even if it rises a little bit about 150, I make money. Yeah, I stand to make money 4 out of 5 cases without having to predict where the market is going. Let me just try to explain that. But before I go on the wrong fallacy that people have about options, a little bit of an example to understand why they're so powerful. Like, So you remember the Euro 2004 that Greece was playing against Portugal. So I hope we don't have any Portuguese guy together with us today. But we played the first match against Portugal, and now Greece, an unknown country from southern Mediterranean, was playing against, a very big team. And the bookies were giving 1 to 240 odds, right? So $1 will get you $240 if Greece were to win the championship, right? So that is an outcome that really pays a lot. It costs a little bit, just nothing, yeah, but it has very small probabilities of making money. So small probabilities of making money, small cost, but very big payout, obviously, because you will have done the impossible. Fast forward 2 weeks, and then Greece has won pretty much every game, and in the last game, we play against Portugal again. Against Portugal, the bookie now, the last game, is giving 1 to 1.4 for Greece to win the championship. That means $1 now can only get you $1.40, whereas before it was getting $240. That means that now there is a huge probability of Greece winning the championship, so that will cost a lot, yeah, but it will pay out a little bit. Yeah, why? Because it's a sure bet. So a sure bet will cost a lot and we pay a little bit. This, in options terminology, is called an in-the-money option. So big probability, yeah, for something to happen. It costs a lot, but it pays out very little. And the other one is called out-of-the-money option. So very low probability of making money, and it costs nothing, but if you do make money, it's like hitting the jackpot. Yeah, so they will pay you a lot. That's the difference between out of the money and in the money, what we call for options. So we're basically doing here a calculation of probabilities, and that's why we want the market not against us, with us. So we're not betting with directionality, because that will make no difference with everybody else. We want to bet something that will allow us to make money even if we are wrong. And we are occasionally are, right? So let me show you what people think options are, and then go into these 3 strategies. So say we take the example of Apple, right? Our beloved Apple. So we have Apple stock and we have Apple call option. Remember, a call option is something that we buy where we want something to go up, right? So for now, we know that option has to do about probability and volatility and magnitude of movement. Yeah, so a seminar will actually teach you how these are combined and intertwined. But obviously, wasting assets means, first and foremost, they lose value. So I can't really be there to buy. What I typically say, and what we were saying at the City Trading Room, fantastic experience, 930 places in Canary Wharf, 2nd floor, and everybody shouting like crazy. And then the AT team, the automated trading hedging system in the middle of that room will tell you, Yanis, when you buy something, you have to sell something. So don't be like the guys who actually want insurance now, and then they think, oh, markets will go up, I don't need insurance, and then I start again. You don't have your house insured for like September and don't leave it uninsured for 2 or 3 months, and then go back and insure it again in January, right? Not even your car. Okay, why do you do it with your portfolio? So when you buy something, you have to sell something. That means that you combine positions that will actually make you recession-proof for your portfolio, if you like. So you aim at making a bit of money every day instead of hitting the jackpot 1 in the 1,000 years. That's the point of using options the way I teach them, at least. So we sell volatility in other ways, and we hedge ourselves. And the other mantra that you actually need, and I do it every day, is when you buy something, you have to lower your cost. So we say pay nothing for something. With options, you can create strategies that can actually protect your portfolio under circumstances and pay nothing. It's zero. So you buy a zero hedging, a zero protection, and then you are protected to an extent for your position. So every time you try to use option, you have to minimize your cost and find ways that the risk-reward ratio is there for you to make money, but still be as protected as possible. Yeah. So You've got 100 shares of Apple, yeah, which nowadays will set you back about $16,000, correct? Because it trades at 160. And if Apple goes up by 10%, yeah, so you stand to make 16 from 160 to 176, yeah, so you make $16. You multiply by 100 shares, so you stand to make $1,600, which is great. But you have to calculate here what your ROI has been, your return on investment. So your investment is $16,000, so you made 10% on your money, correct? Great. On the other side, the other guy who jumps on the internet, knows a little bit of options, has read a couple of books and thinks he can actually go there and dominate the markets, will say, no, why would I spend $16,000 whereas I can buy a call option? Yeah, so first mistake, he buys. So he's got time against him. 87% of the times, these will lose money. Why? I'll show you, because markets are mean reverting. But before jumping there, a call option is equal also to 100 shares. That's how they build them. Yeah? So a call option is like you have the right to buy or sell 100 shares. It's not 90, it's not 110. Is 100 shares. So if I buy a call option, it's like buying 100 shares. But this call option will actually, depending whether you buy it in the money, out of the money, with big or lower probabilities, say it will cost you $3. Yeah, it's not $3, it's actually $300. Why? Because one option is equal to 100 shares, correct? Apple has gone up. Now, obviously, this has a expiration, say, the third Friday of next month, which is 21st of April. Yeah, so it has an expiration. So that means that this will actually have an effect on that. So I pay $300. Apple goes up within that time frame, hopefully, and I make $16 myself. At the end, nothing else applies in terms of volatility, time, or anything. It's just where the market has ended and where you have bought, which, by the way, we call it exercise price. Where would I like to exercise? So say my exercise price was also 160. Yeah, it was 160, the price of Apple. So I buy this call option, 160, I think it's going up. Apple goes up 10%, makes $16. I actually multiply by 100 because one option is 100 shares, and I have made also $1,600. What's the difference here? Well, I deposited $300 and I made $1,600. My return on investment here is a bit less than 6 times. Yeah? Obviously, this is an example. It might be 5 times or 100%, but you can see why people prefer to trade options. But they do it wrongly. Why? Because they buy and this thing is against them. They don't have a strategy and they just think, oh, Apple is going up. Well, it's the same thing. Yeah, he's betting on the upside, right? So there's no difference than somebody who's doing tactical analysis betting on the upside. And it's actually worse. You're doing it with leverage. This has leverage embedded. What's the problem here? 87% of the times you're going to lose this money. Why? Because time is against you. It's very difficult to get the timing right, which is always the case. Yeah? Why? Well, let's talk a little bit about statistics. In a bell-shaped distribution, so the normal distribution taught to us and perfected by Gauss, you have 2 important metrics. One is the Greek letter M, the median, the arithmetic median, yeah? And the other is the standard deviation, correct? So for those of you not statistically savvy, all it means, one standard deviation here, that's one standard deviation, deviate from the mean, it means that 68% of the times I expect the market to move, to go down or to go up. This is drawn like giving you the same probability for the market to go down or the market to go up, which is not the case. The market never has the same probability and people never bet and hedge the same way. They always need to hedge because you don't fear that markets will go up. You always have a fear that markets will go down. So you will always want to push the prices of your protection up, which is very good for us because we have learned how to sell this to you. And as the insurance goes, the insurance game, you stand to lose 9 out of 10 times. So I'm playing on your fear, but also on something which is called reversion to the mean. So this is the mean on a bell-shaped distribution, a normal distribution, and one standard deviation means 68% of the times. 2 standard deviations here is 95% of the time, so 95% confidence is that prices will move either from here to here or from here to here. Yeah, if you take a sample, for example, in a university, to put it bluntly, the average height of a person is about 178. So 178 will be here. And one standard deviation will be what? It will tell you that 68% of the students will be about from 160 height in centimeters, yeah, to 191. And if you go 2 standard deviations, it will mean that 95% of your students will be from 150 to 2.03. And if I go 3 standard deviations, which represent 99% of the sample, then we either have dwarfs or giants in the classroom, correct? That's what it means. But when it comes to investing, it means that how big is the probability that Apple goes to 100 or 200? We probably fall into the 3 standard deviations. So because it's almost certain within X amount of months Apple to move that big, then the payout will be nothing and it's not going to be any worth for you taking it. But if you say Apple has 68% probabilities of staying between 132 and 162, it is quite probable because that's the movement of Apple within the, well actually as of 4 months ago, yeah? So why is it important? Because financial assets tend to revert to their mean. Microsoft, because of the chat GDPI, has gone from 229 to 278, back to 249, 270 again, back to 60, and 2 months ago was around 230, right? Apple was in between 130, 150 for the better part of 2023. And I can think of 1,000 more stocks that have done the same. Unless a stock like Tesla, or favorite Tesla, which fell from 200 to 110, gone back to 200 again within a matter of 2 months. Yeah, you don't need to trade options with that. Of course, options will actually tell you, hey, something's going on here. The market is getting very excited about call options on Tesla. But these are the nitty-gritty stuff that you can find out studying. Or the volatility issues that options provide that actually tell you when a crash is imminent. The stuff that it predicted for the 2020 COVID crash, the stuff that it predicted together with the inversion of the yield curve of the term structure of interest rates, things like that. It's not about trading, it's about reading between the lines, but you have to know the theory, right? So what would an Apple stock do? Well, it goes from here, goes down, goes up, wave down, wave up, a little bit down. And what does it do? Well, it actually has moved around that line, which is the mean. So that's why we try to sell volatility and actually tell that Apple will not go above here or below that and will tend to revert to its mean. That means that it will be losing value because time goes by, and even if it goes away a little bit, it comes back, and that's what financial assets do. So we are here to take advantage of that by doing strategies that can say, if Apple goes up, I make money. If Apple stays, I go money. If it loses a little bit, I make money. I'm sorry. The only way I can lose money is in either extremes. Yeah, depending on the strategy. But for now, we understand. I haven't used a MACD indicator, an RSI, or an MA. It's perfect. I use technical analysis to about 20% of my analysis. But the power of options and the statistics they can give you without needing to read about 50 books, yeah, is awesome. So let me tell you what the strategies are by starting from the simplest, yeah, and this is called a cover call, yeah? So again, you don't need to get too worried about how this is structured and everything. These are things that I explain in my seminar, or you find somebody else in the market. Obviously, you can have a mentor, etc. I'll show you what I teach in my seminar at the end if you're interested. But what it is actually I'll show you why it is always better to use options with your stocks. I didn't say get rid of your stocks or get rid of the long term, but in the short term, such statistical nuances like, you know, the noise that we call it, market going up and down. Powell raised rates by 25 basis points yesterday. Everybody was saying, yeah, that's what you will do. The markets went down 160. Today, markets went up 0.80. There is no logic behind whatsoever. And apart from that, the last month and a half, markets have been oscillating around the 4,000 mark of S&P. So if you were holding an ETF, nothing would have changed. In the meantime, I can definitely guarantee there have been a lot of traders going bankrupt with these ups and downs, unless you are a fantastic scalper and maybe you had your great 1 month of your life. And yes, there have been people making money. Most of the people losing money if they try to time the ups and downs, because there wasn't any real clear sign of how to deal with things. But hey, let's say you want to buy Apple, yeah? Apple, you draw it like that when you buy a share. This is a long future, this is a long stock. So I buy Apple and you guys buy Apple. So we bought 100 shares of Apple, yeah? So what I'm here to tell you is I also sell a call option, strike price 175, let's say that, yeah? So that's how we draw it. It doesn't matter, you learn these things. The important thing is to understand the power of options. So when I sell a call option, what it is that I want the market, in this case Apple, to stay below that strike price that I chose. Yeah, so every time Apple stays or finishes below 175 towards the end of its life, yeah, towards the end of expiration, I stand to make the $2, which is the premium I got. I didn't pay, I put it in my pocket. So somebody paid me to protect my position. Yeah, I get paid, I like to get paid. That's not $2, it's $2 as a, referring to the stock price. It's actually $200 that go into my pocket because you multiply always by 100. Now, that means actually that for me, Apple, I bought it at $158. So I'm always better by $2 than you, and I will explain now. So say Apple does go up and goes to $170 within that time frame until the 21st of April. Great. You make $10 from your stock position, correct? You don't have call option. I have that, yeah? So you make $10 and that's it. I make $10 of my stock position, but I make the $2 from my call option that I sold, the call option that I sold, because it finished below the 175 strike, right? So one scenario is where I make more money than you with the same thing. Apple goes to 175, goes a little bit higher and touches my strike price. You stand to make $15 from the stock. I stand to make $15 from the stock, but I also make the $2 from the option because it has expired worthless. Why? Because the price has not gone above the strike price that I chose. Two scenarios that made more money than you, from you. Apple doesn't do anything. Stays on 160, goes up and down at the end of the options live. Within a month, Apple hasn't done anything. You haven't paid anything, great. You haven't made any money, I haven't made any money, but I got $2 for my option. Third scenario, better than you. Apple falls to 158, you lose $10, I lose $2, so you lose 2, I lose 2, but I make 2 from my option, so I lose nothing here. It's 0 from me. The only time where you stand to make more money than me is the only time, 1 maybe out of 10, that Apple or any Apple will do that. It will go up for whatever reason and stay up, yeah? Because like I said, Microsoft was going up for a week, but then retraced for about $30. Is when market goes up very quickly. So what I do? Well, here, you stand to make money, but I stand to lose money from this point onwards. What is it called? Well, I'm not losing. Why? Because you're making money from 160, say it's going to 200, yeah? And stays there. They don't do these things, yeah? And you don't choose stocks that do these things. But say Apple has done it, 160 to 200, you made $40. I made from 160 to 175, I made $15, yeah? Plus the 2. to 177, I'm still making money from the stock, but I lost all my premium. I gave it back. Not a problem. I put it in my pocket, now I gave it back. So I made $17 from my stock, and then I make nothing more. You make, but I don't make. But I don't lose. You know what this is called? This is called cost, opportunity, cost of capital. It's not called loss. It's just you make more money than I do. But how many times will you make that? One out, I don't know how many. In the meantime, all the other times, perhaps 9 out of 10, I stand to make more money than you. So that's why I want to be in this probabilistic game. And this is a simple way of covering an existing stock position. Fantastic for those of you holding long term. Yeah. But you can see the privilege here. The scenarios 4 out of 5 is that I make more money than you guys who haven't used the call option. Yeah. So for every 100 share, you use 1 call option. So this is hedging, obviously, but it's free money for you, as I said, because markets tend to revert around their mean. Another one, and Warren Buffett used that, is what we call a short put. Now, this is a naked position, and for those of you with a little bit of experience in options know that naked positions are actually, dangerous, because if something goes bad, this obliges you to buy the stock, but you will always be obliged to buy the stock at a higher level than when it trades now. So we use the example of short put, but this can also be what we call a cash secured put. What does it mean? That, the stock might fall, but I have the money to buy it. I had an Alibaba position with a strike price of 85. Alibaba finished 80 on that day. I was made to buy my stocks at 85 while the stock was trading at 80. Within 2 days, Alibaba is trading at 87. So I didn't lose money, but I had a stock position. So you don't lose money when you have the money to support the position. But say we don't have the money, and Apple trades at 160, but honestly, I don't like it at 160. I don't know, but I like it more at 130, which is where the mean of the last 6 months is. So what do? I just say, hey, I choose the strike price of $130, and the short put option will look like that. I sell an option again. What does it mean? I make money. They pay me again. What do they pay me? So say they pay me the standard $2. So they pay me $2 on my stock to do what? Well, if Apple is here and I sell this option, I'm obliged to buy Apple at 130 if it falls below that level, which is our break even. Anything above 130, I make 100% of my premium. How typical or easy is for Apple to lose $30 within my 40-day window until expiration? Very difficult, I will tell you, unless something happens with Putin, another black swan or anything like that. So if you were to choose, Teladoc or Netflix, it might be easy, but you don't do options on this. You don't need to go on these type of stocks. Instead, you can trade, it depends on different factors, but you don't need to go in high beta, high volatility stocks. So what it is here, your scenarios, if Apple goes up, you make all the money. Why? Because it's still higher than $130. And if Apple stays at 160, you make all the money because it's still above 130. And if Apple falls to 140, you still make all the money despite Apple having fallen by 10%. So Apple goes up, I make money. Apple stays the same, I make money. Apple falls by 10%, I make money. It's ridiculous, seriously. Where do I lose? When Apple falls and does a very big move and say finishes at 121, what does it mean? I'm obliged, it's not a right now, it's an obligation to buy Apple shares at 130 while they're trading at 121. Not a problem. If I have the money, as a cash secured put, I buy the Apple shares, and then what do? I go back to the previous page and start selling calls again. Why? Because Apple will actually absorb these low levels, stay for maybe a couple of weeks or even a couple of months, and then starting its way up again. While you're waiting these couple of weeks or months, you stand to make more premiums on the call options. And when market actually shows that Apple goes up, you close the call options at some point, and Apple actually goes back to 160. And you've made money from all the times. Every time that Apple didn't touch the 130, God knows how many $2 you got. And you make money from the call options you sold, and you make money from the shares that have eventually gone back up again. Why? Because financial assets are mean reverting assets, unless we are in a COVID situation, for example. You have situations like that, but COVID doesn't come all too often in our lives, right? Even with the war, there have been, movements up and down, but these strategies were actually working the same. Yeah? Good. If you want it on the other side, just to complement, this actually allows you to buy shares at the price that you wanted. Why did I mention Buffett? Because Buffett will say, I want Coca-Cola here and not here. He will be selling thousands and thousands of options to take billions of premium, and at some point, Coca-Cola will fall. He doesn't matter. He buys Coca-Cola for like 2 lives. Yeah? So it's like buying or setting a limit order to buy here, limit order to buy, except if you don't use options, except while Apple is above your strike price, a limit order will not pay you anything. Options will pay me for months and months until I wait. So while I wait. So I'm getting paid while I wait. Yeah. And let's talk about the last one. Well, you've got about 56 combinations, but at a 40-minute talk, there's only a few things that one can say, but I just want to give you the infinite examples that you can get, the infinite opportunities that you can get with options, right? So the 56 combinations, you can play with time, with volatility, much like a football game. You can tell like Real Madrid will beat Barcelona by 2-0. Yeah, but you can actually bet that the first goal will be scored within the first quarter. And then somebody will score it with a free kick. And the second one will be a penalty. The more options, the more alternatives, the more things you add in an equation, the more difficult it gets to win, and the bigger the payout will be. That's the same with options. Yeah. So that's the 56 things. You don't have to trade 56 different strategies. I trade 6 or 7, because the important thing is, while you make the strategy, how you go out, how you exit the strategy, how you manage your risk when things go bad. Yeah. So let's take a look here. Is a spread. It's a combined situation between 2 types of options. And this time is the put option we're talking about. So a put option typically will protect you against a fall. It's your insurance. Yeah, so much like you pay insurance for your house, you would buy a put option to protect your portfolio. The problem is that we end up again doing the thing that I hate the most, buying. No, I want to sell. So what do? I do a combination. I sell and I buy. When you buy something, you have to sell something. Why? You lower your expectations, you lower your payout, but you also lower your risk and you lower your cost. And this is how you need to think as professional traders, if I may. And even if you don't do trading for a living, the majority of you don't, then it's still the same strategy that you can use wherever your portfolio, wherever the assets you are trading or investing in, and wherever your time frame horizon, because options, you can trade them, the 0 DT, probably you've seen in the news, the 0 days to expiration options. So you trade within a day, this thing goes up like crazy. 100% up, 200% down. It's going like crazy, but it's not the same. And that's the beauty of it. They have different behavior when there are 30 days to expiration, different when they have 5 days to expiration, because there are different factors, which by the way, we call them the 5 Greeks, surprisingly so, that affect, we call them the sensitivity factors, volatility, time, the movement of the underlying, and so on and so forth. But to keep a long story short, what do I want to do? I want to sell a put option, much like I just did before in my previous slide, so to speak. Why? At, say, Apple. Yeah, Apple trades at 160, so I would like to buy Apple at 150. Or I would like to make money whenever or as long as Apple remains or stays above 150. But I don't want to buy Apple in case it falls. And honestly, I'm not sure where Apple is going. So what do? I buy my insurance. I go to 140 or 135 strike, and I buy my put option. Why do I draw these things like that? Well, they're not arbitrarily drawn, they're like that. But you don't need to know for now how they're drawn. But what you get is actually this combined position. This is called a bull put spread. What does it do? It sells volatility, so it bets that something ideally needs to die a slow death, so days go by, but I have also my option which will protect me for steep falls. Yeah. So what does it do? Here we have, if Apple goes up to 170, what does it mean? Here I sold the options, I got my $2. Yeah. And then I bought an option, but I bought an option to protect myself from 135 and below. That option, I mean, Apple being at 160, I buy my insurance for 135 and below. That means that Apple has to fall $25, and then I start to get insured. And I'm talking at the end of the options life, because in between crazy things can happen. But for the sake of the argument, we're talking about end of expiration charts. So it's a big disadvantage, and I'm not going to pay $2 for that. I'm going to pay, for example, 60 cents. So what have I got as a premium at the end? $2 minus 60 cents. I got $140. This is what I need to know. I'm standing to make $140 per every spread that I sold, yeah? Whenever Apple goes up. Because Apple goes up and above 150, I stand to make all of it. If Apple goes down by 10% or by $10, say in this example 8%, I stand to make all of my option premium because it hasn't bridged the 150. If Apple stays at 160, I stand to make all of my premium. So it goes up one scenario, I make all my money. Stays the same, I make all my money. Falls by 8%, I stand to make all my money from the premium. So I take the premium at the start, and then it stays in my pocket. Yeah. So where do I lose, Yanis? Yeah. Well, where you lose is actually, this is the break-even point. Yeah. So the break-even point is what? If I got 140 and this is the strike 150, this level is 150 minus 140, which is my premium. So it's 148.60. Below 148.60 and up to 135, I lose money. So I've got a $13 window where I lose money. And that's the bad thing. Why? The risk-reward ratio is 1 to 12. I stand to make, or 1 to 13 in this case, I stand to make $1.4, it's actually 112, a little bit less, $1.4, and I stand to lose what? $1,300. Doesn't make any sense, right? The good news is that you stand to make money 87 to 90% of the times with that. Why? Because time value is your friend now, is your ally. Options will lose value, and you get to keep the whole premium, and also financial assets are mean reverting. Even if Apple falls by 10%, the probabilities are 68% of the time for one standard deviation, which is how I pick the strike prices. They are not arbitrarily picked. Yeah? Apple will actually, even if it falls, will go back again. Yeah? Within this short time frame. So 90% of the time, I'm going to make money. The bad news is that one time that I fall, I stand to lose a lot of money, so I don't let it. So what do I do in finishing within the next 5 minutes? Just to give you a thumbs up. Well, my first choice of risk management is to move this strike. So say Apple goes 148, I have to move my strike to the next month, say May. So what do? I roll down in time. Why does it help me? Because now I've got 30 more days. And 30 more days is a lot of time for Apple to move around a little bit and then hopefully go back again above 148. And I stand to make all my money again. Yeah. But Apple has gone into a very downward spiral. It doesn't work and keeps falling and goes to 145. So now I have to do a second exit strategy. What is that? I have to roll it out in time and down in strike. So I don't use the same strike now. I go to 140 strike. My 135 put options are still making money because Apple is falling. That's my insurance. But I'm losing from the short put. So now I move it down to another strike and down or further away to a month. So I gain more time and I gain more room for maneuver. Yeah. But hey, shit happens, excuse my friends. And Apple continues to go down. I mean, sometimes very good stocks, like Alibaba, for example, which I used to trade, tend to go into a very bad phase, and nobody knows why. So, third time, what do? You do what we call a delta hedging. What is delta hedging? Without going into much detail, it means that from this point onwards, whatever this put option loses, I will have another option that will make money exactly the same. So if that option, the short option, continues to lose, I will have a position with another type of option, so more purchased options that stand to make money as of this position. So the more I see Apple going unstable, etc., I can do my delta hedging and protect my portfolio and make it immune to market going up and down. So I stand to make money from the time going by. If you don't want to do a delta hedging because it costs a lot, you pay commissions, you don't know, you're not expert, etc., what do? The stop loss is when that option reaches about 200% loss. It's not a lot, don't get panicked. What does it mean? If I sold that one, it's gone to $3, I have to hedge it. How? The delta hedging. You can stop loss and exit the position. And normally, when market goes like that aggressively within a short time frame and reaches the 200% loss, it will continue to fall. The same happened with Microsoft, but on the other side, going up. The same happened with ETF, biotechnology, because these guys were taking money from SVB, which collapsed. So XBI was falling 10% in one day for no reason. I mean, this is the systematic risk that you cannot control. So when it falls, it continues to fall. Oil does the same. Rates, the TLT, which is the 20-year bond ETF, had, during a year going only south. So when things go bad and they start at 200%, that means the option has gone now in the money. This is bad for you because you've sold it. So this is now your idea to hedge. What does it mean? At the end, you might end up losing a little bit of money. You might end up losing, but only a little bit. You're not going to lose 13 times and you're not going to lose big. Perhaps it gives you 9 out of 10 times that you made money with selling options all these months. And depending on when the bad thing comes, the bad timing, you might stand to lose some percentage of your positions. But when you're doing these things, you're not facing the market as something of a binary choice. Up, I make money. Down, I lose money. You don't need me for that. You can do it yourself and go buy and do the same that 90% of the people do. Instead, if you want to make something out of it today, you can start thinking out of the box and different than what Bloomberg says or CNBC or your friend at the kiosk. You have to start using options no matter what products you use, what strategy you follow, because like I showed here, hopefully within 3 strategies, you've got a whole new world opening up to you where you stand to make money every week, every expiration, and controlling your risk in the best possible way. There are 56 strategies. Imagine the versatility and the options that they give you to trade, and all you need to do is actually start to learn options in a way that is systematic and very compact and easy to follow. Because if you go on and start reading books and reading blogs and everything, you will learn a little bit, but you won't be able to combine it. It's the same thing with options like technical analysis or fundamental analysis, right? That's why people actually learn more from other people who have chosen this path. And before I go to your questions, if I may, I share my screen and show you a little bit the course outline. So if you're interested in doing options, whether you do it with me or somebody else, but if you do it with me, the course outline to learn about options is talking about diversification of the markets and why inflation has been hitting us hard and what are the similarities, if any, with the 90s, 70s and 80s inflation and the gold standard and all that. The diversification in a portfolio, how you do it, the hedging of a portfolio using your beta, which is the degree of responsiveness to a pull of the market, the correlation coefficients, so a little bit of theory of the capital asset pricing model that you need to actually know to build a well-diversified portfolio that will match your risk criteria and will be actually immune to shocks, whether short-term or medium-term shocks. Learn how to use leverage and margin calculation with futures trading to use your hedging mostly. And then options, as you can see here, I actually talk about risk management, optimizing your risk return, talk about the nitty-gritty of, why do I choose a specific option, how the option chain is read. Yeah, so what are the 5 Greeks and how do I do hedging? We've seen one here with a cover call. There are different situations where you can use with different names like straddles, strangles, collars, iron condors. God knows why they use this terminology, but I can guarantee all you need to learn is 20 new words. These 20 new words is for me and you to help you understand each other without having to use long sentences. And my course is online. And there is one that I actually doing in about 3 weeks' time. It's obviously in English because I do it in different languages. This one is in English and you get to get your recording. So it's yours for life. And then you go over your recordings once we've done it live. That is, I trade live during my sessions. I trade using the same strategies that I teach you. You can see the results of the, other clients of mine who use the strategies that they've been taught. And of course, then I'm here next to you as a mentorship, if you like, because there are other ideas as well where I generate and I share with my clientele to do this thing, open this position with this strike, this premium, etc. But also, most importantly, when to exit, how to hedge a losing position, and why. Right? So you can have the seminar, and then there is also the mentorship that continues. And obviously, I'm available for you guys. Happy to meet in person if you come around at Simon's show on the 28th of April. And I think, you got from the previous slide here my phone number, which you can use on WhatsApp for more information. My website is in 3 languages. One of those is English, so you can find out a bit more about me actually from my YouTube channel, which is here. But then again, like a friend said, most of the information is Spanish and Greek. However, there are a couple of panel moderations that I've done, but you get an idea of testimonials from other people, etc. So let me stop sharing the screen and go back to your questions, if I can find where the screen sharing is.
Superb. What a great presentation. Really, really good.
Well, thank you, Simon.
Can you see the chat box there? But I mean, the huge amount of questions. But Dan is asking about brokers. Do you have a favored, or is there good options brokers for UK-based investors?
Yeah. Okay. So the answer is yes. Yeah, I found it. Let me start. Okay, so different things. The broker that people typically use is Interactive Brokers. You have London branch, etc. I used to trade with TradeStation. You can use Thinkorswim from Tom Sosnoff, etc. I use another Cypriot broker for smaller portfolios because people don't pay the data fees with that, and if you've got a little bit of money and not like in the hundreds of thousands, then the Cypriot market might be better for you. It's still Cyprus, it still cover 100,000 by the equivalent FCS scheme. So then, because IB will ask you a long questionnaire, you have to qualify. It's incredibly difficult to get through a person to talk to. If there is any problem, you better pray God that they will answer you in 5 days. Whereas in Cyprus, it's me you're facing if you want. They speak English perfectly, so you get your job done within a minute. How long is the course? The course is, Steve, 14 hours. So it's arranged over 5 days, 5 evenings. So about 2.5, 3 hours each session. And we do it via Zoom. I sent you the recordings. We do live trading and I cover all the sessions that I sent there. And then you take it home for you forever. And then I'm here to solve any questions, to answer any questions. I'm sorry. A newbie to options will take not a long time to pick this up, Paul, but the best way is go through the seminar and then open an account, put whatever money you want, $2,000, $3,000, it doesn't matter. But don't try to make money from the first year. Try to learn. So the first year is for you to understand, okay, Yanis, you taught me how the theory is and practical and everything, but really what it is about, and yes, it is a Birmingham certificate from my master's. Yeah, thank you very much for recognizing. It is really 1 year. You see the ups and downs, you see the options chain, why an option moves in the way, and then you remember, oh, Yanis told me on the 3rd session, the 4th hour, that evening, let me go back and check. Oh yeah, theory actually follows practice. And then you can see how everything flows. So you don't need a lot of money, just a little bit of money to actually find out how they evolve in practice. So you need live data for that. And if you come to, a Cypriot broker like the one I use, it's a multi-trading platform. So you've got options, you've got stocks, you've got bonds, you've got futures, you've got pretty much everything, right? So you can trade your English stocks if you like. And it's really good. So it depends whether you want to study maybe half an hour a day or 3 hours a day. But the idea here is not to enslave yourself more. I don't want you to put yet another screen in front of you guys. I don't want you to spend another 4 hours. I can have tons of books that I can recommend if you want to do the seminar or not do the seminar, but tons of books for you to read. But as I say, reading a book doesn't make you an expert, and you have to connect the dots. That's the problem in everything. There are millions of books talking about technical analysis, how to make money in the stock market, yet 90% of the people will lose 90% of the money in 90 days. There is a reason for that, yeah? What other questions? Well, I don't see more questions here. Maybe we can stay a little bit, a minute or two longer if you guys like, but I think I stayed within the 1 hour guidelines.
You did really well. Dan was asking about Traders Magazine. He said he's got a lot of copies of the old magazine when it was in English.
Yeah.
Is there any way of getting them in digital form online again?
Not anytime soon, my friend. We wanted to do the English version again back in conjunction with another partnership, but we're not sure if it happens. But I still run the Spanish version. A friend runs the Italian version, and Lothar, my partner, runs the German version. But yeah, we don't have an English version as we speak.
Fantastic. Okay, I think we've just about covered all these.
Yeah.
Thanks, everybody. Thank you, Yanis. Another great my hero during the crisis. Another Yanis Varoufakis, your finance Greek.
Varoufakis.
Varoufakis, yeah. Big part. Yeah. What a hero!
That is with one N.
He was a real hero, and I've read his books as well. Chats with My Daughter, and all these great books, and he just manages to dispel all this economic news. He manages.
Yeah, it's a very controversial personality here in Greece, but yeah. You either love him or hate him. There is no ignoring him.
I imagine. I think I'm on the love him. I quite like his style. It's a big motorbike.
Thank you very much, Steve. Yeah.
Thank you, Jack, for joining us. And we'll catch up again soon. Of course, you're in London actually physically next month.
I am.
Myself at the IX show, Friday the 28th of April. If you haven't got a ticket, just use that button at the bottom here, and you can book yourself a free ticket. We're going to be at Covent Garden It's just between Covent Garden and Holborn. So it's
Okay.
Friday the 28th of April. So look forward to that.
Yeah. Okay. So anybody who's interested in the seminar, etc., just pop a question, WhatsApp, website. Before we meet in person, hopefully on the 28th of April, I will be hosting this seminar, the paid seminar. So if you want more information, feel free to ask. And hopefully it was easy to follow. What can I say?
Very good. Love the flip chart. Love it.
Yeah.
That's a nice break. We like PowerPoint as well, but honestly,
Yeah.
what a lovely break. So
If you get over your 50s, you can't get over your flip chart. You need your flip chart.
take care. We're going to see if our last speaker is available. Yanis, thank you again.
Thank you very much. Take care.